Berkeley, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research with real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading experts on the research they do and how it will affect economic policy. The federal debt now stands at close to 100% of GDP, its highest point since World War II. Most of this debt consists of treasury securities, bills, notes, and bonds that the U.S. government sells to raise funds. The treasury market, where these securities are traded, is among the largest and most important financial markets in the world. Turbulence or dysfunction in the treasury market typically spills over into other debt markets. It can also cause wider market disruptions and in extreme cases affect the macroeconomy. Today's discussion will focus on these issues. In a new BPA paper, Treasury Market Dysfunction and the Role of the Central Bank, Anil Kashyap, Jeremy Stein, Jonathan Wallen, and Joshua Younger discuss risks of disruption in the treasury market and how the Federal Reserve can best address such disruptions when they occur. Kashyap will join David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy, for the discussion.
The authors emphasize that while the treasury market itself can seem remote from the economy, debt issuance is growing with the need to finance record budget deficits, so any disruption may be more costly than ever. Moreover, the Federal Reserve also conducts quantitative easing in the Treasury market, so interventions to smooth disruptions can be conflated with monetary policy. So clarity about the disruptions themselves is needed to have clarity about monetary policy.
Yes, the authors have a really interesting proposal for a more surgical approach to Fed interventions in the treasury market in times of stress. Let's turn it over to David.
Thanks, Jan and John, and Anil, it's good to be with you. So I think it would be useful if we could start by just explaining to people why the treasury market is so important. It's very big, of course. There's about 29 trillion in treasury bills, notes, and bonds outstanding. But what makes this market so important to the U.S. economy, to the global financial system, and to households and businesses?
Well, thanks. It's great to be here. The Treasury market is, as you said, huge, and Treasury securities are free of any default risk. We assume that the U.S. will pay its bills. And so whatever interest rate that the government can borrow at in this very, very large, deep, liquid market sets a floor for every other interest rate in the economy. And so if you're a household or a business, you're never going to be able to borrow at a rate below what the government's borrowing at least the U.S. government historically. And so when treasury rates are going up and down, most other debt is priced as a spread above that rate. And so if there's dysfunction in the treasury market, it gets transmitted very, very quickly.
And it also has a lot to do with how much we have to pay as taxpayers for the money we've borrowed, of course.
Yes, there's that. And it's also the case because it's such a safe and important market, treasury securities are used for collateral in a lot of other borrowing arrangements. So it's a big part of the financial system. It's linked up with the fact that the dollar is the world's reserve currency and everybody prices in dollars. And so having dollar denominated debt is helpful. There's a whole bunch of interconnected things.
Thanks. So, of course, some people buy treasury bills and notes or bonds and hold them in their portfolios forever, but there's quite a bit of trading from day to day, about $900 billion worth of transactions every day, and that's before you get to the various ancillary markets, derivatives and stuff. So in your paper, you focus on major players in the buying and selling of treasuries, asset managers, broker-dealers, and hedge funds. So can you explain exactly what function each of them play and why they're so important to the story you tell in the paper?
Thanks. So the starting point in the causal chain is to say there are a lot of asset managers. So think of either pension funds, insurance companies, or say a bond mutual fund. And they're all trying to earn returns that mimic the mandate they've received. So let's take a bond mutual fund. They're going to have a benchmark against which they're measured. And the benchmark, if it was a long-term bond fund, would say, here's how much we think a representative chunk of bonds would earn, and you should try to exceed that. Now, the easiest way to exceed that would be to buy a lot of corporate debt. If you could buy 20-year corporate debt, that would be nice. It would be long-term. It would pay a credit spread above the treasuries like we were just discussing. And you'd be able to offer your investors more or less a product that they might seek. And it might be cheaper to buy it through a bond fund than buying an individual bond yourself. So it works for everyone. The problem is that there aren't enough long-term corporate bonds for these bond funds to just buy directly. What there is a lot of is shorter-term corporate credit. And so you could buy commercial paper, or maybe you could buy a short-term commercial bond, but you can't get the long stuff. And so to meet their benchmark, what a bond fund tends to do is buy what it can that comes with the spread over the government debt, and then use a derivatives contract to get the maturity to line up with what the benchmark's expecting. And so they might buy a futures contract that would be held, that would give them long-term exposure to interest rates along with the corporate credit. Okay, so far so good. That's step one. Now, step two is the futures market now is out of balance because there's a whole bunch of money. We figure it's an order of magnitude larger amount of money to be managed against these benchmarks than there is native long-term corporate credit. So that means there's a lot of buying in the futures market, and that puts the futures price kind of not quite in the middle of where it belongs. And so what we see is that the futures price is slightly distorted by this because there's so many people on one side of the market. And that brings us now to step two. Who's going to take the other side of the futures market for the futures market to work correctly? And that turns out to be hedge funds. So hedge funds will go in and they will go short futures to take the other side of the trade, to skim off that little profit that comes from the asset managers all leaning to one side of the boat. Okay, but the hedge funds don't want a naked bet on interest rates. So what do? They buy treasury securities. And that covers them against movements in interest rates because they've got a short position in futures and a long treasury position. Now, that doesn't sound very exciting. Hedge funds are in business to make money. And if they did that, the price gap between the futures price and the cash treasuries price is small, maybe 0.1% or 10 basis points. Now, that's not enough to get a hedge fund excited. So how does a hedge fund actually close the deal on this? Well, they have to go and borrow to buy the treasury security. And that brings in our third set of players, the dealers and the money funds that are the ultimate lenders to the hedge funds. So the hedge funds might put down $1 and borrow $99 to buy $100 worth of treasury securities. Now, if you can borrow with that much leverage, all of a sudden that 10 basis point gap gets opened up quite a bit, and that's enough for them to make money. Okay, so far so good. So we've got money funds giving money to dealers to lend on to the hedge funds who take the other side of the treasury futures market that starts with the asset managers. And that all works as long as there aren't disturbances or shocks, as economists would say. And there's a lot of shocks that could show up that could disrupt all of this. The biggest problem is that the hedge funds have put up very little of their own money. And so they don't have to lose much for this process to unwind. So suppose they lost money making an unrelated bet. Let's say they made a bet on something like the price of oil, and they've lost money there, and they now have to cover their losses. Well, they have to come up with the money from somewhere, and they might decide to unwind this trade. And when they do, somebody else has to step in. And that stepping in process is messy because the hedge funds didn't need much yield. They only needed 10 basis points that they levered up to be willing to buy the treasuries. But if you have to convince somebody who's not going to take so much risk with the leverage, then the price has to move a lot to become tempting for somebody else to buy it. And when that price moves by a lot, that means interest rates would go up, and then that transmits the shock. So that's the theory of the paper.
All right, so let's unpack this a little better. So basically, you have the asset managers, the pension funds and others, and they have a trade. to manage their objectives, and the hedge funds have the mirror image of that trade. So far, so good. But the hedge funds don't want to put all their money into this thing, so they borrow a lot. And they borrow from, say, money market mutual funds, where I might put money in. And as long as everything goes as people expect, we're fine. But the world doesn't work that way. And there's a disturbance, and suddenly there's a whole lot of people who want to sell treasuries, and there's not a lot of people who want to buy them. And when that happens, the price of treasuries goes down, and with bonds, when the price goes down, the yield goes up. That means the interest rates on long-term treasuries goes up. Those are the rates that are very important to say for setting mortgages and stuff like that. Now, you didn't write this paper with your co-authors because you thought this was a fun intellectual experiment. We actually had some experience with this not so long ago. So talk a little bit about what happened in March 2020 at the onset of the pandemic and why that makes you think we got a problem we got to fix.
So in March of 2020, right at the beginning of the pandemic, there was a lot of volatility in financial markets. Nobody knew what was going to happen. Maybe the economy was going to shut down. Maybe there was going to be somebody that's going to go bankrupt or whatever. So interest rates were highly volatile. And in our example here, where let's say the hedge funds are on the short side of the futures market, if the price moves the wrong way, then that could mean that the hedge funds have to actually settle up and pay their losses on the futures contract. Well, that requires them to get money from somewhere. And in that case, part of what they did was they sold treasuries. But the treasuries they were selling were very, very highly levered, so they didn't need to have much of a yield. And now the treasury price had to find a new buyer who might not be willing to hold it at such a high price and such a low yield. And so the price had to drop, and that meant the yield had to go up. Now, that happened violently in the first 10 days of March. And the way it ended was the Federal Reserve stepped in and said, you know what, we'll buy. Okay, but they bought in quantities that we've never seen before or since. They started out buying something like $70 billion of treasuries a day. And in 1 week, the last week of March, they bought $362 billion of treasury securities. If you remember back to when we were talking about QE3 for the Fed, they were buying $80 billion a month. And here's 365 in 1 week and 70 a day. And so the Fed ended up becoming the market maker of last resort, buying everything in sight, but it caused all kinds of concerns. Number one, why bail out all these people by saving the people that were selling? They didn't pay for any insurance. Number two, what was the Fed going to do with all of this once they owned it? It turns out we know later they took losses. And number three, maybe most salient at the time, was this confusion over why is the Fed doing this? It started out as kind of a financial rescue operation, but within a week, if you looked at the language the FOMC was using, they were talking about this being to support monetary policy. And eventually they kept buying for a long, long time. So what started out as financial stability morphed into monetary policy. And I think a lot of people looking back at that time say, boy, they wish the Fed hadn't bought that much and had stopped the monetary policy actions sooner. Now that's 2020 hindsight.
But we were kind of lucky that the Fed had to buy a lot of treasuries, and that was at a time when they were trying to keep interest rates low to support the economy, and inflation was actually below their target. So one, it's not hard to imagine, today is a good example, when you would have the Fed being torn. On one hand, we want to buy all these treasuries because the market's going nuts and we have to rescue the treasuries. On the other hand, we're trying to keep interest rates high and tighten monetary policy to fight inflation. So they were lucky that time that both of their objectives faced in the right direction. That wouldn't always be the case.
Yeah, that was exactly our concern, was that if this happens again and you're in a dilemma like you're explaining, where one mandate says go this way, the other mandate says go the other way, what do you do? And so the novel idea in the paper regarding policy was, maybe you don't have to actually buy everything. Maybe what you could do is just say, if the hedge funds are running into stress and want to get out of this trade, instead of having them sell the treasuries and you buy it, maybe you could ask them to sell both the treasury and the futures contract that you have. And that has three advantages relative to just buying. Number one, it's crystal clear in that case that this is a financial stability operation, because for monetary policy, you'd never buy the bundle of a treasury security and the future. Number two, it means that you're definitely hedged and you don't have to worry about this business with losses. The contract will just unwind when the time comes, and you don't have any communication problem explaining why you're doing this, how long you're going to stay in it, what does this mean for monetary policy. There's just no signal in that dimension. So it's in some sense much, much cleaner and a more surgical approach to the problem as opposed to just buying. And the last thing is, you don't have to restore the market to fully function the way it usually did. We were talking about those 10 basis point difference between the treasury price and the futures price. You don't have to buy the bundles so that you keep the price at 10. You could let it go to 50 or 70 or whatever. And in the course of doing that, that would mean that the hedge funds that were showing up to sell to you would be taking some losses. So you would also have a little bit of protection against what economists call moral hazard, this idea of bailing people out who hadn't really paid for any insurance. And so you could design it. It's kind of like the classic lender of last resort that they call Bagehot's rule, which is lend freely at good collateral, but at a penalty rate. And so we could buy these hedged bundles, but at a penalty rate, so that we also don't encourage more risk taking.
So basically what we're saying is, if I got this right, the hedge funds are got to get out of their positions. And if they were smaller or less leveraged and it wasn't at a time of crisis, we might be saying, fine, take your losses. But we can't afford to do that because it would be so disruptive to the treasury market, which is so important, as you explained in the beginning. So what the Fed has basically done is saying, we'll buy what you're selling. And you're saying, okay, but maybe an alternative is you just take the trade that the hedge funds have already got, just take it off. Either way, the hedge funds are getting out. You can structure it so they're not completely bailed out. And you say it'll unwind by itself. Is that because the derivatives expire? How does it automatically end by itself?
Yeah, so you would have taken a derivative position that would match exactly the length of the treasury security you purchased. So if you just hold them all the way to the end, which the Fed could do, or I suspect what they would really want to do is set up some sort of special purpose vehicle like they did in all of their exotic facilities to do this. They'd have to get the Treasury probably to help them to capitalize the thing. But then the Fed would actually just be lending to this SPV, and it would just hold the stuff until it runs off. And if the derivative wasn't lined up exactly as long as they needed, they could roll over another derivative to keep it in place.
So the basic idea is, instead of buying all these treasuries and then having them in your portfolio, which then creates other problems, you just take this trade and over time it'll shrink and you've solved the problem, but you haven't taken on all this baggage. All right, so we're taping this in the middle of April, and these days it's dangerous to talk about the markets or President Trump's tariff policy with more than 15 minutes notice. But we did see a very volatile Treasury market in early April as the president changed his tariffs policy and there were some big swings in the stock market. To the extent we can tell, was what was happening in early April an example of what you feared, of hedge funds undoing their trades and making things messy? Or was it something else, or was it more than one thing, to the extent that we know?
Well, first of all, as my friends who are traders say, the long run is after lunch. And I'm a two-handed economist, so the odds that I'm going to say anything was fully responsible is not going to be there. So I think there was a role for this kind of consideration. In my example, I said it was a futures contract, but the insurance companies and pension funds do it slightly different. They use an interest rate swap. And if you look last week, the swap pricing got dislocated in a way that seemed very strange and unusual. This wasn't as bad as March 2020. Many people pointed out that this didn't get to full-blown crisis, but it sure looked like it was heading that way. And we'll never know because the tariff reversal kind of calmed people down a bit. But the possibility that something like this happens, I think, is quite likely. It's just so fragile. There's something like $1 trillion in this trade. And with the amount of leverage, all it takes is some shock that comes along that nobody was planning for. Who would have thought that tariffs would be connecting to something that leads to chaos in the U.S. Treasury market? The usual story would be if there's chaos in the world markets, people pile into treasuries. And that for sure was not happening. And there's lots of stories about what was going on with that. Maybe it was foreign central banks selling. Maybe it was just that the pension funds are getting nervous or the hedge funds getting nervous, or redemptions from the money market funds that say they can't lend. It seems like we're not going to know for a while. But what I do think this illustrated is the proof of concept that something like this can happen. Because I think when we presented the paper at the conference, I don't think if people had written down the series of steps that were going to lead to this, people would have had tariffs in the first, second, or third item of their list. And it just shows how interconnected everything is. And with this much leverage, it's just a recipe for trouble.
Yeah, it was definitely timely. So one issue here, as I understand it, is that obviously the market for treasuries has grown thanks to the large and growing federal deficit, which means we have to borrow more and more money. But the capacity of the intermediaries, the dealers, to step in and absorb and buy a lot of treasuries or sell treasuries when there's some disruption hasn't grown commensurately. And some of that appears to be regulatory. That is, after the global financial crisis, we did things that have limited their willingness or ability to absorb large amounts of treasuries in a moment of stress. How much of a problem do you think that is? And could that relieve some of the risk of what you described?
Yeah, there are several ancillary things that could ease the stress on this market. I don't think collectively there'll be enough, but you're pointing to one of them, which is the fact that when one of these dealers buys a treasury security, even though it's got no credit risk, they have to hold a little capital against it, and that makes them less likely to do it. The other thing is the way the clearing of the derivatives works also requires some money to be posted to protect the clearing houses, and you could improve clearing. So we're all in favor of both of those things. I just think in the end, this is mostly, though, about whether or not the hedge funds get nervous and want to step out of the trade. And that means anything that threatens their ability to maintain risk. It could just be prudent risk management by them saying, oh, the world's more volatile. We don't want to take quite as much leverage. Well, okay, and then that means somebody else has to step in. So there's many channels through which this could go wrong. But if our diagnosis is right, what it means is the risk-bearing capacity of the hedge funds is now integral to the way the treasury market works. And anything that interferes with that can therefore gum up the treasury market.
I see. Okay, well, I think we'll leave it there. Anil, thanks very much for the very clear explanation. And I hope we don't have to test this again anytime soon, but given what we've seen in the last few weeks, I suspect we'll be visiting this question over and over and over again.
Thank you, David.
Once again, I'm John Steinson.
And I'm Jan Eberly.
And this has been the Brookings podcast on economic activity. Thanks to our guests for this great conversation, and be sure to subscribe to get notifications about new releases of this podcast.
The Brookings podcast on economic activity is produced by the Brookings Podcast Network. Learn more about this and our other podcasts at brookings.edu/podcast. Send feedback to podcasts@brookings.edu and find out more about the Brookings papers on economic activity online at brookings.edu/BPEA.
Thanks to the team that makes this podcast possible: Fred Dews, supervising producer; Chris Miller, co-producer; Gaston Reboredo, co-producer and audio engineer. Show art was designed by Katie Maris, and promotional support comes from our colleagues in Brookings Communications.
I'm Jan Eberly, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research with real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading experts on the research they do and how it will affect economic policy.
Thanks for downloading the first episode of Season 6 of the BPA podcast. This season, we'll be listening to discussions about papers from the Spring 2025 BPA conference, hosted by Brookings on March 27th and 28th.
A number of the topics to be discussed this season are particularly timely. These include China's economic growth, the U.S. trade deficit, and housing affordability.
Plus, we have new papers on the recovery from the COVID-19 recession, labor migration, and the role of the Federal Reserve in preventing Treasury market dysfunction. As always, we're covering a wide range of topics. We're kicking this season off with two veterans of the BPA podcast, Brookings Senior Fellow Gian Maria Malese Ferretti and Maury Obsfeld of the Peterson Institute for International Economics, who both joined our show back in Season 1 to discuss Obsfeld's work on the global dollar cycle. Today, they'll be discussing Obsfeld's new paper, The U.S. Trade Deficit, Myths and Realities.
Jan, this paper seems to be questioning the conventional wisdom about the underlying forces giving rise to the U.S. trade deficit over the past few decades.
That's right. Much of the discussion in the media focuses on the conditions of trade, say competition from other countries or an abundance of global savings, eager to purchase U.S. assets. But this paper brings the story home to the U.S. Maury argues that the U.S. borrows so much from the rest of the world to finance our budget deficit that it's inevitable that we run a trade deficit. These two deficits both reflect the fact that we consume more now than our current income can support. This perspective has important policy implications, since in order to restore balance, it says that the U.S. needs to address internal issues, like bringing revenue and spending into balance, rather than pushing other countries to reduce their trade with the U.S., say by tariffs or other trade restrictions.
Right. It seems Maury is to some extent arguing for a quote-unquote twin deficits explanation, a budget deficit and a trade deficit that go together, similar to what was widely discussed in the 1980s during the Reagan administration. I'm really looking forward to listening to the conversation. Let's turn it over to Gian Maria.
Thank you, Jan and John, and welcome, Maury. Nice to have you back on a Brookings podcast.
Great to be here, Gian Maria.
So I think this paper is as topical as it can be. On the day we are recording this podcast, April 2, we are expecting an announcement of new tariffs imposed by the United States on its trading partners. It is clear from the rhetoric that accompanies these measures that the U.S. trade deficit and the U.S. debtor positions, in the view of the administration, primarily reflect actions that are taken by partner countries, which are in some way taking advantage of the United States. And we have seen just in the past week new data releases from the U.S. Bureau of Economic Analysis, which shows that the U.S. had a current account deficit vis-a-vis the rest of the world of close to 4% of U.S. GDP. So we're talking of something in the range of $1 trillion plus, and a net debtor position, which has now reached about 90% of US GDP. So, Maury, I wanted to start maybe by asking you what you think the administration actions taken so far, as well as the actions we expect to be taken today, could entail for the US economy and how they would deal with the numbers that I have just highlighted.
Well, 2 months into the Trump administration, we've seen a number of tariff announcements, some of which have been quickly withdrawn, then reinstated. It's almost too dizzying to go through all of them, but the ones that seem to have stuck are steel and aluminum tariffs, higher tariffs on China, tariffs on autos, and today, which the administration calls Liberation Day, will presumably involve a much more far-reaching announcement. But again, with this administration, one never knows what to expect. And one factor of the recent experience has been the enormous uncertainty over tariff and trade policy that has been unleashed really since the November election. The news-based measures of trade policy uncertainty that are tracked by several researchers have spiked up to unprecedented levels, and research indicates that such uncertainty has a dampening effect on economic activity, particularly on investment. So we'll see what happens.
So, Maury, thank you very much for this. Can you guide us through your thinking on the diagnosis of the problem that we have that is underpinning really the administration's actions? I know you've discussed these issues in the paper. It would be great to illuminate our listeners on this specific issue.
There are two fundamental variables that the administration focuses on, and particularly the president in his discourse. One is the trade deficit, which probably features more prominently. The president views a trade deficit as evidence that the United States is losing from trade when it imports more than it exports. The other related issue is the level of manufacturing employment. Of course, manufacturing employment in the U.S. has dropped precipitously since its heyday in the early post-war period. Certainly, manufacturing employment as a percent of GDP has dropped more slowly since the global financial crisis, but it continues to decline. This fall is reflected in the hollowing out of industry in the Rust Belt states and elsewhere in the U.S. These are states that are electorally very important. And President Trump and his allies maintain that the primary cause of this hollowing out is international trade, which has led to the loss in U.S. jobs and also a loss in U.S. assets. You cited the recent figures on U.S. net international investment position, negative 90% of GDP, and that in part reflects losses incurred through ongoing trade deficits with the rest of the world. The administration believes that the tariffs that are going to be rolled out and that have been rolled out can correct both of these problems, both return the U.S. trade balance to balance and reverse the decline in manufacturing employment and bring a big increase in factories and manufacturing jobs.
And is your sense that the diagnosis of the problem is correct? So do you see the U.S. trade deficit as something that is really a reflection of foreigners in some way taking advantage of the U.S. and hollowing out its manufacturing structure?
I think the fundamental answer is no, that the decline in manufacturing bears some relation to trade issues, to the evolving nature of the global economy and the broader scheme of things. Around the year 1990, we had China entering the world economy in a big way, India reforming, the collapse of the Soviet bloc, and those countries entering the world economy. So we certainly had a rise in the global supply of labor, which I think has played some role in making lower priced goods available to the U.S. and depressing global wages. So this is certainly something that is real, but the fundamental driver of declining manufacturing employment, which we see around the world in surplus countries and in deficit countries, has been rising productivity in manufacturing, which accompanies rising incomes and rising demands for the goods that are produced in the service sector. So to some level, declining manufacturing employment is an inevitable consequence of the structural transformation brought by higher productivity growth in tradable goods. The idea that the trade deficit is a function of foreign victimization of the U.S., I think is way off the mark. There are a number of theories of why this might be true. One is that U.S. trade liberalization and foreign trade practices have led to a U.S. deficit. Another is that a global glutton saving, driven in part by foreign countries' suppression of consumption among their populations, has created capital flows into the U.S. that require, as a counterpart, more U.S. consumption and more U.S. imports. And a final theory is that the specific role of the dollar as an international currency, and notably as an international reserve currency, requires the U.S. to run current account deficits to supply the world with dollars. And I would argue that all three of these views are, at best, partial and at worst, completely incorrect. Fundamentally, the U.S. trade deficit is a macroeconomic phenomenon. It reflects the fact that the U.S. spends more than it produces. It is true that the rest of the world, therefore, spends less than it produces, but that doesn't establish that the rest of the world's actions are in some way forcing the U.S. to spend more than it produces. And that's the sense in which the critics of trade complain that the U.S. is a victim. The U.S. is being forced to spend more than it produces. And I think that conclusion is very hard to support.
Thank you very much, Maury. And yes, I think some of the problems, the large figure on the U.S. debtor position, that negative net international investment position, which means basically the net claims that other countries have on the United States, the size of that position is very large, but it does depend also on the value that assets located in the United States have. We all know how the value of U.S. stocks has skyrocketed in the past decade and a half, and that contributes to U.S. wealth. But since some of these stocks are owned by foreign investors, it does increase net U.S. liabilities vis-a-vis the rest of the world. So what do you think would be needed to address problems related to U.S. external accounts? So is the trade deficit, is the current account deficit a problem? Is the big debtor position a problem? How can the United States implement policies that would help mitigate those problems?
Well, as you pointed out, has to interpret the U.S. debtor position with caution because it's only one component of U.S. wealth. And to take an example, as you pointed out, last year, the U.S. current account deficit was 3.9% GDP. So if that were the only driver of the U.S. international position, the U.S. international position would have deteriorated by 3.9 percentage points of GDP. In fact, it deteriorated by almost 20 percentage points of GDP. And the primary reason was that the U.S. stock market did so well relative to foreign stock markets, which increases U.S. wealth. So in the broad picture of U.S. wealth owners did well. Another factor was the dollar's appreciation, which improves the U.S. terms of trade and also benefits American consumers. So we have to be careful in looking at the net international investment position and concluding that the U.S. is so incredibly indebted that it can never dig its way out of that hole. That is only one portion of U.S. wealth, which includes the U.S.'s very productive capital stock, some of which is publicly traded and is a more important component of U.S. wealth. Now, I worry more about another deficit, which is the U.S. federal deficit. And that's intimately linked to the current account deficit because it's a big part of the reason, not the only part, but a big part of the reason why the U.S. saves so little and therefore borrows abroad. Last year, the U.S. federal deficit was 6.5% of GDP. If U.S. saving cannot fully provide those funds to the U.S. government, it has to borrow abroad. And that's where the connection comes in with the deficit. There are legitimate worries, particularly with Congress preparing to take actions which will increase the deficit, that international lenders may be reaching a point where it may be harder to borrow abroad in terms of the world demanding higher interest rates. That's a big problem for the fiscal position of the U.S. The U.S. government could address that problem while also improving its trade balance, giving some more support to manufacturing by taking actions that bring down the government deficit. Those would involve, if they were to be durable, significant rethinking about entitlement programs and how to fund those longer term, not just chainsaw cuts to government spending that don't amount to much, and also serious thinking about revenue sources, not just the administration's current idea of going back to the tariff-based revenue system of the McKinley era.
Thanks, Maury. And indeed, what you say about the fiscal deficit ties in with the evolution of the net international investment position as well. We mentioned the good side of increasing equity prices, if you want, the good reasons for the increase in U.S. liabilities. But you also have close to 50% of U.S. GDP worth in net debt, in debt instruments as opposed to equity, where the argument that high valuations reflect the strength of the U.S. economy is, of course, more questionable than is the case for equity. So I wanted to turn to lessons from history, really. These are not new debates, the size of the U.S. current account deficit, the dynamics of U.S. external liabilities. A lot of these themes were at the center of policy discussions even before the global financial crisis. And your paper does a masterful job of discussing those issues and putting history at work to evaluate the various theories that have been put out to explain what has happened. So can you guide us a bit through that? So how did we get where we are in terms of U.S. deficit and external positions? And what is your view on the extent to which these developments are driven by U.S.-specific factors versus the behavior or, if you want, the underlying macro evolution in trading partners?
Well, the really long history, at least the long post-war history, is that the U.S. entered the post-war era with trade surplus, and that has declined over time. The U.S. trade balance has been negative since sometime in the 1970s. In fact, the weakness of the trade balance was one of the factors in President Nixon leaving the Bretton Woods gold arrangements and trying to devalue the dollar in 1971. Where you really see a sharp change, I think, or a sharp move toward deficit, toward the protracted deficits that we've had, the uninterrupted deficits, is in the Reagan era. If you look from, say, 1960 to 1980, the U.S. rate of personal saving was about 10%. Around 1980, it's been closer to 5%. So that's a big structural change in the behavior of households. Now, of course, there's also corporate saving and government saving. But in the 80s, you also had a shift to very large government deficits under the Reagan administration, a much larger current account deficit. And at some level, we've not been able to really get away from that. It's true that President Clinton's administration was able to bring the budget briefly back to surplus, but that was quickly undone by the Bush tax cuts. And moreover, other factors under the second Bush administration led to unprecedented current account deficits. And I focus on that period in my paper because I think it's so important for understanding the current policy and political environment that we're in. In the decade of the 2000s, the current account deficit approached 6% of GDP. It's a figure hasn't been matched, was never matched before, has not been matched since. And that naturally gave rise to a lot of consternation, a lot of debate. It was also the decade of the China shock, the decade in which a number of heartland U.S. communities were absolutely devastated by Chinese import competition. And it was also the decade that saw a big housing boom in the U.S. bubble, most would say, that led to the global financial crisis. And we've been living since then with economic narratives and political repercussions that really come out of the China shock period and the global financial crisis. And that decade also, the decline in manufacturing above and beyond the China shock was absolutely precipitous. Absolutely precipitous. Now, of course, that's also the period when the internet became a thing. We had productivity gains coming from that technological development. In the paper that you mentioned, I tried to talk about this period and what were really the factors driving the huge U.S. current account deficit. A prominent narrative at the time was the global saving glut theory. In a nutshell, that theory held that after the Asian crisis of 1997, 1998, those countries wanted to self-insure by accumulating dollar foreign exchange reserves. This, together with energy surpluses by the big oil exporters, led to a glut of global saving, which entered the U.S. in the form of capital inflows, pushing down interest rates, appreciating the dollar, and in part igniting the housing boom and taking us up to the events of 2008 and the financial crisis. And I try to push back on that by introducing a more complex narrative in which, at least in the years from 2002 to 2008, capital is being pulled in by U.S. domestic factors rather than pushed in by foreign saving. Those domestic factors are primarily financial innovation in the housing sector that allows for much more debt issuance, particularly mortgage debt issuance, which drives up housing prices, increasing homeowners' equity, leading to more debt issuance to extract that equity, and driving the current account deficit. Now, of course, there are still factors pushing capital into the U.S. There's this big accretion of foreign exchange reserves, which helps keep U.S. interest rates lower. But for me, one of the telling factors or telling bits of evidence over this period from 2002 to the crisis is that you would think that if capital was pushing into the U.S., the dollar would be appreciating. But actually, it is depreciating very strongly all over this period. And that, to me, says that really what is driving the dollar is all of this debt issuance by U.S. households connected with the housing crisis. So that's a somewhat more complex narrative, but it's also one that puts in context this narrative that the U.S. is the helpless victim of foreign forces. I mean, of course, there are policies that could have been followed then to tighten up the mortgage market, reduce subprime mortgage borrowing. Not only would these have limited the deficit, limited the harm to manufacturing, but they also might have reduced the severity of the housing crisis that we ultimately suffered.
Thank you, Maury. And I think we look at the implications of theories formulated back then for what is happening more recently. We have to see how many things have shifted between the decades. As you were pointing out, there was substantial accumulation of foreign reserves in the period leading up to the global financial crisis and even in the years immediately after that.
Right, absolutely.
But that has waned. And if one looks at the statistics on the size of global foreign exchange reserves in relation to the size of the global economy, we see a pretty substantial drop since those years. I mean, the maximum was reached around 2012, 2013. Since then, it's been declining. So it is very hard to make the argument that this continued desire to accumulate more reserves that somehow can explain the overall dynamics of inflows into the United States. I wanted to ask you how you see the role of China. You've touched upon it already in your remarks when talking about the hollowing out of manufacturing, but there is this view out there that China is the largest creditor of the United States, which is absolutely incorrect. But how do you see the role of China in explaining the dynamics of the US current account and US liabilities?
Well, China really begins to become a major factor in the mid-2000s. Now, notwithstanding the China shock, which I think affected certain communities particularly strongly, but if you just look at the data on global imbalances, China's imbalance compared to that of the U.S., China's surplus compared to the U.S. deficit in the 2000s starts out pretty small, and then it becomes more important. But over that entire period, if we look at the deficit vis-a-vis China as compared to the U.S. overall trade deficit with all trade partners, it's not nearly the majority of that. It certainly becomes more important. And as you said, Chinese reserve accumulation really becomes important after the global financial crisis. It really spikes up. And then, of course, China has its own crisis in the mid-2010s where it spends a quarter of its reserves defending the currency. And by the way, if that were the main driver of the U.S. current account, we should have seen $1 trillion improvement in the U.S. current account balance. We did not. So just putting that factoid out there. Now, I think even today, the importance of China is exaggerated. Now, let me be clear. There's no doubt that the fact that China suppresses consumption and runs a surplus contributes to the overall U.S. deficit. In terms of a global equilibrium, that would have to be the case. And there's no doubt that China pursues strategies of overcapacity and export promotion that can be injurious to competing industries elsewhere. Those things are definitely true. But to blame the overall U.S. deficit on China and those practices is just quantitatively way off the mark. For one thing, trade practices are second-order determinants of the overall current account. And secondly, China's surplus is only about a third the size, at least in 2023, of the U.S. current account deficit for that year. Now, the 2024 numbers we'll know better in a couple of weeks when the IMF releases its World Economic Outlook. But most of the global surplus that is the counterpart of the U.S. deficit actually comes from advanced economies at the moment.
Absolutely. And indeed, those are the largest creditors of the United States. And although China runs a still large bilateral trade surplus vis-a-vis the U.S., its investment pattern has changed dramatically since those years when fundamentally the Chinese surpluses were mirrored by an accumulation of reserves. China is investing in other emerging economies, Belt and Road initiatives and other, uses its dollars in a different way, and its claims on the US have remained actually quite stable in dollar terms, and so declining as in relative terms. It's a big change, and so associating bilateral balances with bilateral creditor positions is just off the mark. Well, Maury, thank you very much. This was a fascinating tour through issues that are really central to the attention of global policymakers at the moment. And I strongly encourage everybody to read the paper. It is a fascinating read, including because of the depth of the historical analysis that underpins it. Thank you very much.
Thank you, Gian Maria. It's a pleasure, as always.
Once again, I'm John Steinson.
And I'm Jan Eberly.
And this has been the Brookings podcast on economic activity. Thanks to our guests for this great conversation, and be sure to subscribe to get notifications about new releases of this podcast.
The Brookings podcast on economic activity is produced by the Brookings Podcast Network. Learn more about this and our other podcasts at brookings.edu/podcast. Send feedback to podcasts@brookings.edu and find out more about the Brookings papers on economic activity online at brookings.edu/BPEA.
Thanks to the team that makes this podcast possible: Fred Dews, supervising producer; Chris Miller, co-producer; Gaston Reboredo, co-producer and audio engineer. Show art was designed by Katie Maris, and promotional support comes from our colleagues in Brookings Communications.
I'm Jan Eberly, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research with real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading economists on the research they do and how it will affect economic policy.
This year, the Federal Reserve will begin its 5-year review of the monetary policy framework it adopted in 2020. At this year's Brookings Papers on Economic Activity conference, we convened a small symposium to discuss the Fed's framework ahead of that review: what's working, what isn't, what the Fed should consider revising, and what should remain the same. Today's episode of the BPEA podcast features an interview with two experts with intimate experience with the Fed framework: Brian Sack, former executive vice president of the Federal Reserve Bank of New York, and Christina Romer, former chair of the President's Council of Economic Advisors, who presented new papers in the symposium. Today, they're interviewed by David Wessel, director of Brookings Hutchins Center on Fiscal and Monetary Policy.
The Fed initiated these regular reviews only 5 years ago, actually following a proposal that was raised and discussed in a 2018 BPEA paper titled, "Should the Fed Regularly Evaluate Its Monetary Policy Framework?" The 2020 review resulted in some subtle but important changes to the framework, which many have argued may have played a role in the bout of inflation we experienced post-COVID. Whether we should keep these new features or modify them is an important part of the discussion this time around. Now let's turn it over to David and hear his conversation with Brian and Christy.
Thank you, Jen and John. Christy, it's good to be with you today.
Nice to be with you.
And it's good to be with you, Brian.
Thanks for having me.
So, Christy, let me start with you. The focus of this discussion at the Brookings Papers on Economic Activity was the Fed's framework. When you look at the framework that the Fed adopted in August 2020, what do you think of it, and what role did it play in the Fed's slow response to the increase of inflation that was triggered by the COVID episode?
Well, the framework that was reviewed before August 20th, and then they came out with a new one, had what we see as kind of at least 4 important changes from their previous framework. One was the introduction of what's called flexible average inflation targeting, which is just simply the idea that the Fed says if inflation's been running below our target for a while, we'll have a period when inflation runs above our target, so we're on target on average. So that was one change. A second change that got a lot of notice was in terms of the second part of their mandate, maximum employment. One of the things that they said is they would respond when employment was below maximum, but not when employment was above maximum, unless there were some other problems. And then two other changes that were more subtle, but in our paper we argue are actually probably more important to the slow response to inflation, are first an elevation or a strengthening of the maximum employment goal. All the legislation said is the Fed's supposed to head toward maximum employment, but how they interpret it is obviously very important. And traditionally, the Fed had interpreted it as something closer to a normal level of employment or a sustainable level of employment. And the new framework really elevated that and had it much closer to something like we're going to aim for a hot labor market, not just a sustainable, comfortable labor market. And then the other subtle change was a move away really from preemption, this notion that the Fed is going to respond to what they see happening in the future rather than to just where inflation and employment are right now. And in our going through, where did the slow response to inflation come from? We think it's that elevation of the maximum employment goal to being a hot labor market goal and the moving away from having a very forward-looking monetary policy.
Thanks, Christy. Brian, do you see it similarly? Are there other parts of the framework that you think are worth noting?
No, I see it largely similarly. I mean, first of all, I think the Fed should be commended for having done the review, taken a step back and asking what changes should it consider to its framework in order to meet its mandate. But I think in the end, they ended up with a set of changes that was probably geared too specifically to some of the challenges that they had been facing for the period since the global financial crisis. And those challenges were all involved sluggish economic growth, low inflation, and the constraints from the effect of lower bound. So I think the framework changes that were made were too strongly geared in that direction. And I guess I would add another element to it, to what Christy said, which is there's the changes that were actually made to the framework. And then there are also the decisions on implementing that framework with the tools that they have. Those tools being guidance on the policy rate and asset purchases by the Fed. And so I think this framework review, as we come to it again, needs to not just look at the changes that were made to the framework document that Christy was talking about, but also the decisions that were made to implement that framework.
Right. So let me expand on that a little bit. So you made a couple of points there. One of them was that this was basically a framework written after a period of below target inflation, which was adopted with the benefit of hindsight, at exactly the wrong moment when suddenly we were going to have an increase in inflation. So you're suggesting they were too much looking in the mirror. But secondly, you made another good point, which is not only do they have a framework, but they implemented it by giving what economists call forward guidance, that is, giving the markets advice about what they intend to do. And in your paper, Brian, you call out the fact that in September 2020, a month after they announced the framework, they said that it would be appropriate to maintain a zero interest rate until labor market conditions have reached levels consistent with their assessment of maximum employment. And in your slides, you underline the word and, inflation has risen to 2% and is on track to moderately exceed 2% for some time. So when I hear that, I think the guidance basically reinforced the gestalt of the framework, but it tied their hands even more. Is that the point you were trying to make?
Yes, I think the guidance was driven by the framework. It was intended to deliver the objectives of the framework, but in its implementation, made some mistakes in how that conditioning was laid out. In particular, you noted we underlined the word and. I think that type of conditioning with that and clause proved to be problematic. So it's certainly good practice to condition your guidance about short rates on economic conditions. It's been done in the past. It can be a very effective policy device to lay out the kind of conditions that you would need to see before lifting off from, say, the lower bound. But in this case, by requiring both of those conditions to be met, they, in my view, tied their hands too firmly and unnecessarily did so. And in particular, first of all, it's already relatively aggressive to say we're going to keep the policy rate at 0 until we get inflation back to the target and the unemployment rate to full employment. So even if you knew you were going to hit those conditions at the same point in time, that's already a relatively aggressive policy, because in most cases, you would think when you get to those conditions, which are sort of like equilibrium conditions for the economy, the policy rate should be near its equilibrium level or its neutral level, which is typically above 0. So that was aggressive to begin with. But I think the real problem was this structure meant that both conditions had to be met. So in circumstances where inflation was moving up rapidly and the full employment condition had not yet been met, this effectively tied the FOMC's hands in a way that really didn't put a bound on how far off track they could get in terms of having their policy rate respond to inflation. We often talk about, in the economic research literature, we talk about monetary policy rules, which are devices, formulas that describe how monetary policy is typically set for economic conditions. And those rules, in many models, deliver very good performance. So it's not that the central bank always follows a rule, but they give a nice reference point for thinking about good policy. And in the context of thinking about policy rules, basically this guidance allowed the deviation from the rule to be very large in size. So the FOMC fell many percentage points below what the rule said policy should have been set at because of this form of the guidance that required both conditions to be met before liftoff.
Right. And Christy, that echoes some of the comments that you've made. You and your co-author, David Romer, argue that the Fed's desire to have a hot labor market, one in which unemployment is as low as possible and as many people as possible are working, and its unwillingness to act preemptively, as Brian described, contributed to this slow response to inflation. And in your paper, you put this in historical perspective. And I wonder if you could explain a bit the technique that you and David used to examine the Fed decision-making in the past and what conclusions you draw from it.
Absolutely. So first, I think it is important to discuss, what do we mean when we say the Fed was slow to respond? And here, the basic facts are by March of 2021, inflation had already gone above the Fed's 2% target. And what's really striking, as Brian's been suggesting, is that they waited a full year until March of 2022 before we had the first rise in the funds rate. And so that's what we were trying to investigate in our papers. What role did that change in the framework perhaps play in that year-long wait to raise the funds rate? And the method that we use is basically to listen to what policymakers said. So we read the minutes of the FOMC meetings, we look at the speeches that the Fed chair, Jerome Powell, made, that Vice Chair of the FOMC and President of the Federal Reserve Bank of New York, John Williams, made, to try to tease out how they were interpreting their new framework, how it was influencing what they did. And so what we do is to just read a lot and try to figure out what they were saying and what they were thinking. And so an example, remember we said one of the things that the framework did was to elevate the maximum employment goal and strengthen it. Well, how do we see that? Well, one is what Brian described in the forward guidance, that they said we want inflation up to our 2% target and we want employment at maximum. No idea that there might be a trade-off between those two goals, or it might not be possible to have both those goals. So they really were putting maximum employment right equal with their goals for inflation. We also see, for example, Jerome Powell, the Fed chair, in his speeches talk about how important a really strong labor market is, particularly for low and moderate income communities. Or we see John Williams, just right after they start to raise rates, say the labor market is sizzling hot. We're finally at maximum employment. That's how we figure out, there's been a change here in how they're interpreting that maximum employment goal. So I think that's the technique that we use. And as you mentioned, what we find is that elevation of the maximum employment goal really did hold them back. They're sitting there saying, boy, inflation is 5%, 7%. They know it's high. They know it's predicted to stay high for a while, and they're still holding back. And you hear them saying, but we're not at our back to new employment goal. The labor market is not yet sizzling hot. And so that's how we do the forensic analysis of where did this slow response come from.
Brian, when you were speaking at the Brookings conference in September, we knew that inflation was already coming down. We seemed to be avoiding the recession that many of us expected. So what do you think the costs were of this tardy response? Yes, we had a run-up of inflation, but it came down as supply chains adjusted, and it turned out that inflation expectations were well behaved. How big a mistake was this? What were the costs of the mistake, if you think it was one?
I think that's a very good question and a good issue to consider as we think about reviewing this framework. I would argue that even if the FOMC has managed to pull off a soft landing, I think there's two things to consider that suggest we shouldn't just give a free pass to the framework or to the path of policy that we were on. So the first thing is, we've had a lot of overheating and a lot of inflation over this interim period. Now, you pointed to supply chains, and I think certainly some of that inflation was inevitable. Much of it wouldn't have been avoided under a different policy path. But I do think this policy path with the slow response certainly added to the overheating we saw in the economy, certainly added to the inflation path we were on. By delaying liftoff, the Fed effectively created some of the most accommodative financial conditions we had seen in some time in the economy, at a time when the economy was growing rapidly for other reasons and beginning to overheat. So I do think it was a counterproductive path to be on, even if it was subsequently corrected in a way that limited the ultimate damage. The second point I would make is going on that path and relying on the ability to correct the mistake later on is a riskier strategy. They had to raise rates very rapidly to restore their inflation credibility. That certainly risked a more dramatic slowdown in the economy. It creates more risk of financial accident. We did have some financial stress, of course, in the banking sector. And it also created risks on inflation. In the end, they were able to keep inflation expectations contained and bring inflation back down to date. But if inflation expectations had proven somewhat more fragile, it could have been even costlier. So I think a path that puts you so far from normal benchmarks for policy rules and then requires an aggressive correction is not an optimal path, and we shouldn't give the framework a free pass just because we avoided the absolute worst outcomes.
Right. In other words, it was a risk you don't think they should take, and they got lucky. That's the headline I'd put on what you just said.
It's a risk they didn't have to take. They got lucky, but they also, they did correct. I think they deserve credit for realizing that as the tightening cycle got underway, they had to get more aggressive to achieve this outcome, but it was a riskier path, and I think they had to be on.
Let me just add one thing, David, which is that I agree with everything that Brian said, but there's also just this other element that people really hate inflation. We've been through such a long period where inflation's been low. I think policymakers may have forgotten just how much people really dislike inflation. Even if their wages are going up at the same rate, it just is a visceral response. And now we see, right, inflation's low, but all people are noticing is, but the price of eggs is still not back down to where it was in 2019 or 2020. And so we don't want to lose sight of just that it makes people really unhappy, and it may affect how they view the economy, how they vote, their expectations and spending. So we need to realize that going through a year of quite high inflation may have had important consequences.
Yeah, that's a very good point. So the Fed is sitting down now to begin this review of the framework. I know for a fact that they have read your papers and listened to the discussion because one of the Fed governors mentioned it to me. So, Christy, let me start with you. What should they do differently? What should they change and what should they keep the same?
There are a couple things I want to echo from Brian's comments, which one is just the Fed does deserve a lot of credit, both for having a framework review back in 2019 and 2020, because it's just good policymaking to look at what you've done, what's gone right, what's gone wrong, and see if you want to change it. And I think it's great that they're doing this again. And the fact that they're reading what academics and people in markets are saying, I think is really valuable. I also want to echo, I think Brian hit the nail just right on the head when he said the problem with the last framework review is that it was somewhat too tied to the mistakes that they'd just made, to sort of what had been going wrong after the financial crisis and the Great Recession. And so they came up with a framework that would deal with that problem maybe quite well, but was not robust when they were suddenly hit with a very different problem, which is a pandemic and a bunch of post-pandemic inflation. So the big picture as they go on to the review is to say, let's get something more robust, more general, and able to take into account a wider range of things that they might face. And in doing this, I think our point of view is, the flexible average inflation targeting is not a bad idea. The notion that we may be at the effective lower bound on interest rates more often going forward. We may find ourselves with sometimes inflation being too low and maybe not as many tools as we'd like to deal with it, to say, let's have a policy that will take care of that. And so I think the average inflation targeting is not a bad idea. And then in terms of things to change, since we do see this trying to elevate the maximum employment goal to something closer to a hot labor market, I think is just not a sensible strategy. That a crucial fact is that monetary policy can't solve every problem, right? It is a very poor tool for dealing with very important issues like inequality and lack of opportunity for many communities and things like that. Those are real problems. They're just unfortunately not problems that monetary policy is very good at dealing with. Those are problems that you need Congress and the president to come up with policies that are really going to be effective. And the best thing that monetary policy can do is keep inflation low and keep the economy growing at that normal, sustainable level. And so I would recommend going back to the older interpretation of maximum employment is that sustainable, comfortable level of the economy. Likewise, I think we're going to want to respond to deviations from maximum, both above and below. One of the things that we do in the paper is just to look back at history, going back to World War II and saying, those times when the Fed did let the labor market get hot, how did it work out? And in all of the cases, something went wrong. Either it was inflation, that's what usually happened, or sometimes it shows up in a bubble and bust in financial markets. And so the Fed really, I think, would be well served by having a more sustainable notion of maximum employment.
I guess the people who take the other side of this argument would basically say that for a long time, the Fed was tighter than necessary, that they thought that inflation was very sensitive to unemployment, and it turned out not to be that sensitive, and that's the lesson they drew from the post-global financial crisis period. And so they think that the Fed was systematically too tight, and you're saying, yeah, that's not the way you read history.
Well, there were real problems with policy coming out of the Great Recession. I think policy was often too tight. But the answer to that is to not say, so what we're going to do is aim for a much hotter economy, is to say, why did we make that mistake? Why did we not do enough after the Great Recession? And that really comes to this notion that they need to keep doing preemption. They need to keep looking forward because monetary policy affects the economy with a very long lag. But in a case like after the Great Recession, where they kept their forecasts kept being very wrong, the answer is not to throw away the forecast. It's to say, what do we do wrong? And how do we get better forecasts? And how do we have a better read on where the economy is headed. So I think the right message for the framework is keep being forward-looking, have a sensible estimate of what maximum employment is, but then do a really good job and invest a lot of resources into making a very good projection of where the economy is headed.
So, Brian, what would you do if you had the pen rewriting the framework?
I think I agree with Christy in almost every way. I think the framework document itself should be more what we call constitutional. It should provide a structure for effective policymaking that applies to a wide range of economic circumstances. That's not tailored to the one particular circumstance that's been in place. So for me, in terms of the current framework document, that would mean going back and reversing the change that was made on shortfalls. I think this idea of only responding to shortfalls to full employment as opposed to deviations was very asymmetric and very aimed at those particular circumstances that
Let
I
me
mentioned.
just interrupt you to just explain what that you mean is the Fed framework basically said when unemployment is high, we're going to react aggressively. And when it's low, we're going to not react aggressively.
Yes, exactly. So I think I would just take that out of the framework document. I think it's too specific and it's too problematic in some circumstances to be in the framework document. In terms of the other large asymmetry or change in the framework document, the average inflation targeting, I'm a bit more against average inflation targeting than I think Christy is. It's a bit of a different argument. I don't think it's problematic necessarily. I just think it's not that far from just flexible inflation targeting. And the averaging part was vague enough in the framework that I don't think it's actually helping a great deal. So I don't think it's problematic to keep it. But on the other hand, I just don't think it's that beneficial. So I would basically remove both of those pieces and just have the framework document focus on a set of principles that I think are very robust across economic circumstances. And then, as I mentioned towards the beginning, I would also, in the review, very carefully look at the implementation. We talked a lot about the guidance. I think the lesson on the guidance is make sure you're conditioning on economic variables in a robust and effective manner. And we didn't touch on QE, which is the other tool, but I think there's also lessons to be drawn on QE. I think on QE, it's very important for them. The QE is the asset purchases that the Fed conducts to help support financial conditions. I think it's very important to hold QE to the same type of standards that we hold the main policy instrument to, in terms of let's make sure it's calibrated appropriately for the economy. Let's make sure we communicate clearly about QE. And let's make sure its purpose is clear, whether it's aimed at market functioning purposes or just broad policy accommodation. I know I'm touching on some things we didn't actually get to, but I think these should be important pieces of the framework review as the Fed gets to it.
Finally, let me pick up on that for the final question about Fed communications, which supposedly is part of the review, although the last time they kind of ducked it. Christy, in your paper, you said you guys should use forward guidance much more sparingly. Like, I think what you were saying is when you have a clear message, like they did during the global financial crisis, that we're going to keep rates at zero for a long time, so don't panic when the economy picks up, that's useful then, but at other times they can just tie their hands. And I'm curious, okay, but what would you do about the famous dot plot, the quarterly report at which the 19 members of the Federal Open Market Committee give their predictions for what will happen to short-term rates under some conditions that are not really very well explained? Would you keep it or do away with it?
Well, let me first just reiterate, there are times when forward guidance is useful. I think what our perspective is that if the Fed states very clearly what their goals are, and they make it very clear they're going to use all of their tools, not just the interest rates, but as Brian mentioned, asset purchases, communications, then in some level saying, and here's, what we're going to do to the funds rate for this period is in some ways overkill, and that it can often constrain them because we already have two tools that we can use to stabilize the economy. We have fiscal policy, we have monetary policy. Fiscal policy is inherently slow. You got to get an act through Congress. That can take a really long time. So it's really valuable to have a tool that can respond quickly. And I think one of the things that forward guidance does is the Fed kind of gets locked in. And we saw this when interest rate or when inflation was going up. The Fed was really hesitant to change because they've made this forward guidance and they don't want to surprise financial markets. So that's kind of what's behind our thought that don't just routinely use forward guidance, save it for when you really need another communications tool. On the dot plots, again, it's useful to have transparency in Fed policymakers to say where they think the economy's headed. The trouble with them making where they say they think the funds rate is headed is people focus in on that in a very counterproductive way, right? They say, what's the dot in the middle? That's where the Fed's going to be. Well, it's not. There are 19 people on that committee, and there's sometimes a huge range, and sometimes there's a little range. And so I think often the dot plots just end up confusing people because of the way they're either reported or interpreted by a lot of people out there in the economy. So it's not a hill I'm going to die on. Let's get rid of those. But I think they can cause problems.
Okay, Brian, defend the dot.
I'd be very sad if the dots went away. Well, first of all, let me say that, I think the Fed and other central banks, they're in the business of communicating about their policy path. It's really unavoidable. So to Christy's point, there are times when you want to turn that up with explicit guidance, and maybe those times you save for the right circumstances. And when you're stuck at the effective lower bound, those are certainly circumstances where that's productive. But at other times, you're still communicating about at least your expected path for policy. And that's really what the dot plot provides as well. So I think the dot plot's an important part of that. And I would argue it's a highly effective part of that. It's not perfect, but it's pretty effective. And the reason is it's quantitative. Whereas we get an FOMC statement that's qualitative and descriptive, but the dot plot and the whole SEP forecast gives you that quantitative reading on explicitly about what FOMC members are seeing for the economy. And then by tying that with the dots, it gives you a lot of information about their reaction function and their policy intentions. So I think it's a very important communication device for the markets. And I don't think the markets just oversimplify and take it on board. I think markets understand these are forecasts that won't necessarily come true. They understand that there's a variety of views. They understand that they may want to weight different views differently. So to me, it's a piece of information that gets used pretty efficiently by the markets and helps policy be effective.
Well, great. I'm glad that by the end of this conversation, I found something in which you're not in furious agreement. Brian Stack and Christy Romer, thanks very much for your time and for the work you put into these papers, because I know that they're having influence on policymakers as they try and do better next time.
Well, thanks, David. Thanks, Brian. It was nice to have the conversation.
Thank you, David. Great to talk to you. Thanks.
Once again, I'm John Steinson.
And I'm Jan Eberly.
And this has been Season 5 of the Brookings podcast on economic activity. Thanks to our guests for this great conversation, as well as a big thanks to all the BPA authors and Brookings experts who joined the podcast this season. Be sure to subscribe to get notifications when we launch Season 6, which will be in April 2025.
The Brookings podcast on economic activity is produced by the Brookings Podcast Network. Learn more about this and our other podcasts at brookings.edu/podcasts. Send feedback to podcasts@brookings.edu and find out more about the Brookings papers on economic activity online at brookings.edu/BPEA.
Thanks to the team that makes this pod supervising producer, co-producers Fred Dews and Chris Miller, audio engineer Gaston Reboredo. Show art was designed by Katie Maris at Brookings, and promotional support comes from our colleagues in Brookings Communications.
I'm Jan Eberly, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research with real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading economists on the research they do and how it will affect economic policy.
With a global transition to clean power already underway, many policymakers and researchers have celebrated the potential for positive environmental impact. But less celebrated and less understood are the positive economic impacts of a grid running on clean power. That's the subject of a new paper, The Economic Impacts of Clean Power, by Kostas Arkalakis of Yale University and Connor Walsh of Columbia Business School. Connor joins Sanjay Patnaik, director of Brookings Center on Regulation and Markets, to discuss the new research.
It is really amazing to me how widely views differ when it comes to our prospects relating to climate change. A lot of people are very pessimistic, both about the likely path of emissions and also about the likely sacrifices needed to bring about the needed change. Others, on the other hand, are much more optimistic. The optimists tend to point to very rapid technical change in the renewable sector, and some go so far as to predict that we might be on the verge of a future of abundant, very cheap energy. Kostas and Connor are more on the optimistic side of this debate, and the present paper is trying to draw out some of the macroeconomic implications of a future where electricity prices may fall quite a bit, especially in very windy and sunny parts of the country.
The authors also push forward in thinking about climate change and energy policy as a macroeconomic issue. Their approach takes into account spatial variation across the country, as you mentioned, but also examines the potential aggregate implications for economic growth over the longer term. Now let's turn it over to Sanjay.
Thanks a lot, Jan and John. It is great to have the opportunity to discuss this fascinating paper on the economic impacts of clean energy. It is my pleasure to welcome Connor to the podcast. Thanks for joining me.
No, thanks for having me.
So let's dive right into the findings of your paper. There has been a significant increase in green electrical generation in the last 15 years. Solar and wind produced about 14% of electricity in the United States in February 2024, up from about 2% in 2010. Before we get to the impacts, can you talk about what caused that increase? Better technology, specific policies, market forces?
It's really a combination of factors. Renewables have been supported in the US for quite some time with things like production tax credits. But the real thing that's changed in the last decade has been dramatic declines in the capital costs of clean energy, in particular solar panels and wind turbines. We've seen them come down very fast, not just in the US, but internationally. Solar is particularly fast. It's falling something like 15% a year worldwide. And so this is just driving huge opportunities for uptake of these technologies to supply the grid.
And so you note in your paper that a lot of attention that this change has gotten is because of the environmental impacts. Lower fossil fuel use means lower greenhouse gas emissions, which is obviously important in the fight against climate change. Your study focuses on another important aspect of this transition, which are the economic impacts. Can you walk me through the economic impacts that your model shows?
Yeah, it's something we think that gets a little underappreciated about renewable energy is that it puts significant downward pressure on wholesale prices across the grid. And the reason is it basically has very low or even zero input costs. You don't really need fuel for renewable energy. You put a solar panel in the sunshine, you put a wind turbine in the wind, it generates electricity with very low variable costs. And what this means is that when renewable energy projects bid into supply into the grid, they're usually the lowest cost suppliers when they're available. And this means that whenever they're available, market clearing prices for electricity tend to fall the more renewables you have on the grid. So the really dominant force determining the cost of power of renewable supply is those upfront capital costs, the cost of the wind turbines, the cost of the solar panels, the cost of construction, and what we call balance of system costs as well. And so as these technologies become cheaper, it very naturally puts downward pressure on wholesale prices across the US. And we're starting to see this in locations that have already high penetrations of renewables. So there's a lot of wind power in the middle of the country, very windy places like North Dakota. There's a lot of solar panels coming online in California, in Texas. And in these places, in the middle of the day, when sunshine's very abundant, we see very, very low wholesale power prices, even negative in some places. So the more of this stuff that comes online, we expect it to push down electricity prices across the US. And so we've been thinking a lot about what the economic impacts of these price falls are going to be. We developed a relatively general model of production where we think through the price impact of cheaper electricity prices onto production, wages, and growth in general.
This is actually very interesting and I think often very underappreciated. So can you tell me a bit more about the underlying model that you developed to make these projections? Are there any aspects where you're less certain about the predictions and the assumptions you made?
Yeah, so it's a relatively flexible model. It's in a class of models we call quantitative spatial models. I think the basic idea of the results we write down is the impact of electricity price falls depend rather intuitively on how intensively electricity is used in production in a certain place and in a certain industry. So, for example, there are some industries that are extremely energy intensive. Aluminum smelting is one. Aluminum smelting generally spends almost as much on electricity as they do on direct labor costs. And so places where you have very energy intensive industries interacted with places that have good renewable resources are going to be the places that benefit the most from these changing power costs. So the model gets at that intuition. It's very what we would call a first order result, as in we're only thinking about local power price changes. It's not a great model for thinking about how electricity causes reallocation of industry across the US. So a good example might be cheap power in places like Arizona and Nevada could cause manufacturing to locate there in the future. Right now, there's a lot of manufacturing in the old Rust Belt of the US and in the southeast of the country, but not a lot in Arizona and New Mexico. Once you get very, very cheap electricity, that creates incentives for businesses to move across space. And one limitation of the model we write down is explicitly ignoring this kind of reallocation of long-run economic activity. We're really only thinking about the short-run impacts of cheaper power onto wages and production.
That's actually really interesting. And one thing that I'd like to bring up is you mentioned in your paper that your model shows that electricity costs will fall by 20 to 80% depending on local solar resources and could lead to a 2 to 3% aggregate real wage increase. One aspect of this that I'm curious about is how realistic are those estimates if you think about demand for electricity? If demand for electricity goes up, for instance, due to the growth of AI data centers, which we have seen across the country, and also the drive to decarbonize and electrify our economy, if we have that increased demand for electricity and it's not matched by an increased supply, for instance, because of permitting issues, there would be pressure for prices to rise. How does your model account for this?
Absolutely. I mean, the focus of the model is primarily a supply-driven model, as in we make an assumption that at least in the medium to long run, solar and wind will be able to enter in places where there are relatively high costs. So at the moment, that is a big issue. So permitting is maybe the main issue facing the electricity industry at the moment. On average, it takes anywhere up to 5 years to connect a solar project at the moment to the grid, because of many things, because of interconnection costs, because of studies of reliability that have to be done, and all the entry of new renewable energy projects is sort of congesting other projects that are trying to enter at this time. So at the moment, this has been a significant issue that it's hard to get interconnection into the grid, but we see this as mainly a transitional issue. In the long run, as these barriers start to fall, we think that the cost side will dominate on this question. So just the idea that you mentioned about AI and data centers increasing demand for power, we think that's right. We think there will be substantial electrification of industry and substantial increases in demand from these new technologies. The argument that we make is that in the medium to long run, anywhere on the grid that prices rise above the level that would justify solar investment backed by storage, so firmed solar investment, you should see solar entry. And what that does, that tends to place a ceiling on the price increases that we should see. That's kind of independent of demand. The real assumption, though, that you've hit the nail on the head there, is the relative ease of entry. Is it easy to, in the medium to long run, create solar power projects and wind projects? I think one key concern that people bring up a lot is the availability of land. And for wind power in particular, this may be an issue in the future. We don't see it being a huge issue for solar, though. And in the paper, we go into detail on this. The National Renewable Energy Laboratory provides great estimates out there of how much developable solar power there is, as in what's the potential land we could use for solar power. I'll just give you a figure off the top of my head. You could meet almost all of current US demand with less than 2% of the developable solar power out there, which is about 0.6% of the US land on the continental United States. Now, 0.6% sounds like a lot of land, but at the same time, that's about 5 times the land we use for golf courses. So it's large, but it's not that large considering the things that we do with our land.
I guess one of the issues there would be that the land would be in one part of the US where there's more sunshine, and then it would be hard to transmit all the electricity to our population centers. Have you guys accounted for that?
Absolutely, yes. So transmission is a key issue that we've been working on in this and in other papers. Transmission costs are very heterogeneous across the US. So there are estimates out there that transmission costs are fairly low in the middle of the country, but connecting and building new high voltage transmission lines, very expensive in places like California and New England. New England in particular, or at least the northeast of the US, very heavy load center, and there's just not a lot of transmission capacity going from the northeast to the very sunny areas of the country. So we see huge opportunities for building out this transmission infrastructure. And in the paper, we size some of the gains on offer. We do something very simple. We say, suppose everywhere in the US had access to the lowest solar power costs, basically the places that are the sunniest, like Arizona. What would that do to aggregate wage gains? And we see big increases in wage gains from sort of building out transmission infrastructure. So we think this is a big prize on the order of, well, the maximum gain we calculate you could get out of building out transmission infrastructure. It's about $300 billion a year. So transmission infrastructure is expensive, but those kind of aggregate gains are very, very large. And so we think the prize here is quite substantial.
I think that's a really interesting angle to it because, so we have done some work on permitting, even at my center at Brookings. And when we look at permitting reform, the potential impact and positive impact on real wages that could come from this infrastructure is not something that people talk about often. So I love that. I think that's a really important finding.
Right. No,
that is critical.
It's one of these indirect benefits that often don't come up, especially when you're talking about electricity markets. Analyses tend to be very local and industry specific. But electricity is such an important input into production that it's going to have all kinds of macroeconomic effects to make this input cheaper. And we think getting at those effects is something really important to do.
And so I think that brings me also to kind of like my final question. When we look at the economic impacts of the green energy transition, this is not something a lot of policymakers really talk about in detail. Do you think they should? Or are the effects just too uncertain that it's hard to try to convey these facts to the public?
No, I think one of the great benefits of this transition is that it's almost a free lunch, as in it's going to clean up the environment. We're going to see much lower CO2 emissions from particularly the power sector. And at the same time, we're going to get cheaper power. So anything that speeds up this transition, such as the Biden administration's Inflation Reduction Act with their production tax credits and investment tax credits, it's almost a free lunch. Now, changes in these policies that we might see from the new administration, it's still too early to tell what's going to happen there. But the clean energy juggernaut, I think at this point is unstoppable. These things are getting so cheap and they're being installed so rapidly, not just in the US, but across the globe. I think there's very little room for policy to derail the transition. Policy could slow down the transition, but I think we're moving very quickly into a world that's dominated by renewables.
And just to follow up on that, how do you see the issue of base load power with renewables that are a bit more intermittent, especially when we look at night, for instance, with solar power plants? So how do you solve that problem?
So there's two dimensions to intermittency that I think are very important. First is the daily intermittency of solar panels. As you mentioned, there's no power there at night. I think we're quickly getting to the place where lithium ion solves this problem. So we do cost estimates in this paper that if you add 8 hours of lithium ion storage to a solar plant, it effectively makes all the hours of sunlight during the day completely dispatchable. So any solar plant can store all their energy and dispatch it at the times of highest demand. We'll get significant overbuilding because, of course, there's only 8 hours roughly or even less of sunlight that you can capture a day. So you need more solar plants to supply during the night and during the early morning, let's say. But lithium-ion batteries have reached the price point where they're starting to solve this daily intermittency problem. And we're seeing this already in ERCOT and in CAISO in California, where we've seen just an explosion in battery installations in the last 2 years. And if you look in California in particular, batteries are already supplying up to 1 to 2 hours of the early evening peak, siphoning off solar power from the day and redirecting that to the evening. We will see that increase from here for sure. So projections are updated every day, the amount of battery storage that's getting installed on the grid. There's a second intermittency problem, though, that I don't think lithium ion is that well suited to solve, and that's the seasonal intermittency problem. So there's much less solar power in the winter, and wind is also variable over kind of weekly and monthly horizons. Now, we just don't have good storage technology that's cheap enough at the moment to solve this long duration storage problem. But I think the capital is getting so cheap now, solar and wind capital, that partially overbuilding our capacity somewhat mitigates this problem. So the idea being, well, there's less sunlight during the winter, overbuild solar capacity, and in the summer, either we just waste that electricity because it's so cheap, it's free, or we will find a use for it. I mean, wasting the electricity in summer is the worst case scenario. I'm very confident in the ability of the market to take this price signal of cheap solar power in the summer and do something interesting with it, whether that's converted into hydrogen, whether that's variable computing loads, desalination. There are all kinds of things you could think of doing with excess electricity in the summer. But at the moment, I mean, this seasonal issue, it is a real issue, but if capital keeps getting cheaper for solar and wind, I think it becomes less of an issue over time just because you overbuild this stuff.
Well, thank you so much, Connor, for joining me today. It's a really fascinating paper, and I hope it will have some positive policy impacts.
Great. Thanks so much for having me.
I'm Jan Eberly, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research with real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading economists on the research they do and how it will affect economic policy. The topic of today's episode is the sanctions the U.S. has put in place against Russia in response to its invasion of Ukraine. These have been in place for over 2 years now, and many policymakers and commentators have debated their efficacy. In a new paper, Oleg Itskoki of Harvard University and Elena Rybakova of the Peterson Institute for International Economics start by taking a step back and asking the larger question, what does it mean for sanctions to work? They joined Ben Harris, Brookings Vice President and Director of the Economic Studies Program at Brookings, to discuss their paper titled, The Economics of Sanctions, How Do They Work in Theory and in Practice?
Economic policy has become a larger part of international relations and diplomacy, with sanctions of goods and services, financial services, and payments being deployed to try to resolve international disputes or to prevent them in the future. Oleg and Alina show what these tools are intended to do, what they do in practice, and when they can be a double-edged sword. Higher prices, for example, can affect the global economy, not just the sanctioned country, which may also be interconnected with other countries that have their own agendas.
Yeah, sanctions on a large country like Russia clearly can't be effective unless the countries imposing the sanctions are willing to bear the costs that the sanctions impose on them, such as higher oil prices in this case. But let's turn it over to Ben and hear his conversation with Oleg and Elena.
Thank you, Jan. Thank you, John. Really appreciate it. Very much looking forward to today's podcast. Let me start off by saying hello to our featured authors today. Elena, welcome.
Thank you. It's a pleasure to be here.
And Oleg, welcome to you.
Hi, great to be here.
Great. So let's just jump right into it. One of the things I really liked about your BPA paper was that you take on both theory and practical application of sanctions. So oftentimes when we hear about sanctions, there's sort of this assumed theoretical underpinnings to the sanctions. We don't really talk about why these sanctions are being levied in the first place or what the ultimate goals are or how we'll evaluate the efficacy of the sanctions. So your paper does a really good job, I think, of marrying the two. But can we just sort of jump right into the fundamental question? The title of your paper is How Do Sanctions Work in Theory and in Practice? So before we dig into specific examples, let's just start with that, maybe some background. What are sanctions and what effect are they designed to have and what do they do in practice?
Thank you. We want to think about sanctions as something broadly defined because when you look at the press, sanctions brings a lot of kind of associations to people. So we want to say, look, this is economic statecraft. This is using tools of economic policy to exert pressure to achieve national security, foreign policy, or maybe even military security objectives. So this is how we think about economic statecraft. And economic statecraft encompasses a lot of measures. It includes sanctions, financial sector sanctions. Many people more recently will say, well, sanctions is just about finance. No, if you look at the historical literatures, actually sanctions were mostly about trade historically, right? But then since the US gotten so successful with financial sanctions, we identify now it's with finance. So it can be limits on finance, it can be limits on access to foreign markets, it can be limits on trade. So it's all other measures of economic statecraft put together. Why are sanctions used? I think you asked a fantastic question. When people think about sanctions, they think, oh my goodness, they're going to achieve everything. No, it is not a magic bullet. Various dictators around the world are not going to die tomorrow or lose their power because we impose sanctions on them. So I think it's important to be realistic about the use of sanctions. They might be, more realistically, to deter somebody from doing something. So, for example, if in 2014 Putin invaded partially Ukraine, we imposed sanctions and signaled certain sanctions to say, look, if you move further, this is what's going to happen. And potentially, and we also argue in our paper, that might have stopped Putin from moving further into the country. Sanctions can be also about imposing cost. Once you have done something evil, well, we're going to impose sanctions on you because we want to impose cost. Sanctions specifically in 2022 case on Russia, and Ben, you know more than anybody else about it here, is about degrading Russia's ability to continue the war. That's another wonderful measure. So realistic sort of targets, measurable targets are good targets. Sanctions that in theory should change the regime, that gets a bit more complicated.
And to add a little bit more background to this description, right, you pointed out trade and financial sanction, and it's actually important to keep the two separately. So the two things that connects countries internationally, one is trade. And in principle, in the limit of full sanctions policy, you can cut down this trade to zero. You can put a country into autarky where the country needs to produce on its own everything that it needs. You know, in the modern world, no country does that. There is a lot of trade linkages. And so what sanctions do, they really on the margin reduce the trade overall or trade in particular inputs that, for example, are used in military production or dual use goods. And so those are sanctions on trade. Sanctions on trade are costly because it means that both countries would trade less. Both the sanctioned coalition would trade less and the country under sanctions would trade less. And so this is the way the impact is generated, right? But the second type of sanctions are financial sanctions. And the idea, the premise is that countries rely on Western financial systems. They use dollars in transactions or as a vehicle of savings for liquidity. They use payment systems such as Visa and MasterCards. They require clearance of international payments using SWIFT. And so this is the Western infrastructure. It's not trade in goods but it's the use of Western financial infrastructure. And this is a different type of sanctions, right, that you can impose directly on the financial system. And this is sort of, in a way, a less costly thing that Western countries can do to the extent the country that they're trying to impact relies a lot on these financial services.
Great. Well, thank you for that helpful background. Let's dig into the paper a bit more. So in your paper, you note that sanctions policy is less likely to be effective against countries that can easily substitute away from foreign goods towards domestic ones. So this suggests, in general, that countries with larger economies can weather sanctions better than those with smaller, more dependent economies. Do you guys mind elaborating on this? In terms of international trade, what are the characteristics of a particular economy that can make sanctions especially impactful? When are they less likely to work?
Yes, and so this is the basic insight from international trade, is that, of course, the more countries trade with each other, the more impactful would be sanctions on limiting those trade flows, right? And so here, there are two factors that really matter. How much do you trade? And so if you're imposing sanctions on a small country, the small country tends to be small from the perspective of the rest of the world. So the rest of the world does not rely so much on the goods produced in a small country. But for the small country, the rest of the world is very important. And so when there is a big difference in size between the sanctioning coalition and the country on which you're trying to exert influence, this is when the sanctions are most effective and least costly for the sanctioning coalition, right? Because they can leverage their relative size. This is the first lesson. And the second lesson, sanctions are costlier, the harder it is to substitute away, right? So if you stop selling some crucial goods to a country, and the country needs to produce those goods domestically, that's one situation. The other situation is when that country can source those goods from other countries, right? If the other countries don't join the coalition and are willing to substitute the trade with the coalition, for example, of Western countries, the sanctions are much, much less costly because that substitution is much easier to do than to procure all the goods domestically. And so as a result, these are really the insights. It's how much you trade and how easy the country would find it to substitute away from the goods that you trade.
I think it's about making a list of items, which is the most costly for the sanctioning country going down, and the other side, what is the most painful for the country being sanctioned going down. And you try to flip that and find this sweet spot of leverage where US, for example, and its allies have the most leverage and it's least costly, but at the same time very impactful on Russia. And in 2014, that was found very wonderfully because that was the financial sector axis. Russia at the time borrowed more than 700 billion in outstanding gross debt. And for the US markets, Russia was pretty much negligible. So cutting off Russia from the financial markets and its sectors of the economy was very impactful. But then, of course, now it is more challenging. This larger, more integrated into global trade economy might have the dominant power in a market. In Russia's case, it's energy markets, which makes it also costly for the sanctioning coalition. And on the other hand, as Oleg has explained, if there is a coalition of countries that is willing to help Russia, that means our enforcement has to be so much more powerful. And I think here we need to bring the question of enforcement. It's not just enough to announce something, but it's also extremely important to enforce what you're announcing.
That's great. So you brought up a bunch of issues, which we'll get to later on. You brought up Russia in general. You brought up Russia and energy markets and specifics, which we'll get to in a second. And you also brought up enforcement. But before we jump to the Russia context, maybe we can just pause for a minute and talk about financial sanctions. And so you made that distinction from the outset, the difference between sanctioning financial transactions and sanctioning trade. And so can you explain to us circumstances when financial sanctions will and won't work, and also when financial sanctions might be counterproductive?
Well, financial sanctions and the US, when the banker hears that, they ask how high. They don't ask, do I jump? They ask, oh my goodness, how high? But it hasn't been always like that. You, Ben, of course, remember very well, and Oleg as well. In early 2000s, post 9/11, with the Patriot Act and other measures, and Treasury finding its secret power, it wasn't immediately the case. Treasury invested a lot of time Once they understood that they're controlling the critical node, they have the dominant power in the global provision of financial services. And it's not just about the dollar loan. As Oleg explained very well, this is also about financial infrastructure. It's holding the critical nodes and being able to control them, sometimes even physically, right? So this is the power of the US financial sanctions. Once they realized that, the US authorities realized, they started building global infrastructure. For example, anti-money laundering rules, reaching out to international institutions saying this is extremely important. We want to clean up the financial system. And I think it's a very honorable, it's a great thing to do, but at the same time, it enhances the leverage of the US financial sanctions. So I think that's why 20 or more years on, we know that the financial sector sanctions are extremely impactful. So on the way, we've had multi-billion-dollar fines applied on banks who didn't quite get the memo the first time around. Eventually, they got the memo. So what are the risks, what you're saying? When can it be counterproductive? When there isn't a global understanding, and we'll get to it, about the doctrine, some countries will say, no, you're just trying to make my life difficult. It's not about anti-money laundering and cleaning up the financial system. It's about you trying to put me down for other orthogonal geopolitical reasons. So therefore, what I'm going to do, I'm going to create fragmentation. I'll try to drive some of my markets to other nodes. I will try to remove the centrality of the US node and move somewhere else. And in practical terms, that means I will try to diversify. Maybe I will try to find alternative systems to SWIFT. I'll try to find alternative systems to US dollar settlement. I will try to fragment the market. And this is the key risk, because as fragmentation takes hold, then of course the effectiveness of the US sanctions will be also less impactful.
And just to add to this beautiful description, it's important to emphasize financial sanctions are cheap. It's easy to impose them. It's easy relatively to enforce them in comparison to trade sanctions. And so if you have that instrument, you really want to use it. Unlike, for example, sanctions on trade, where you have to give up purchasing cheap Russian oil or gas, that's costly for the countries. But imposing sanctions on the financial system comes almost at no cost. The problem, exactly as Elena described, when countries anticipate that, especially if they were given a warning, they would wane themselves off the Western financial systems. They will use dollar less. They will use payment systems less. They will use clearance systems less. And that's exactly what we observed, right? The financial sanctions that were imposed and announced in 2014, the Russia knew they're coming and prepared over the next 8 years. And the strategy was to actually fragment itself from the Western financial system, rely more on the domestic financial system, more on the fragmented systems with China and other countries, which makes financial sanctions at the next stage so much less impactful and effective. And so while the West would love to use them more, there are limits which come from the fact that countries can substitute to alternative financial systems.
That's really interesting. So it's your view that in 2022 through 2024, and perhaps longer, that the U.S.'s ability to levy financial sanctions on Russia is diminished because Russia responded to the 2014 sanctions by laying out a groundwork to avoid future sanctions by the U.S., which came 10 years later.
Absolutely. And in fact, what you see is, when would the sanctions work? Well, when the country relies a lot on the Western financial system, and Russia increasingly was reducing its reliance on the Western financial system, limited the amount of external debt. It started the full-scale invasion in 22 when it was relying very little on Western financial markets. It did a lot to try to replace domestic payment systems. It was not quite ready to the sanctions that were announced at first on the Russian assets. That came as a big surprise because it did change the existing rules at that moment, and that was an effective surprise. But at the next iterations, there would be much less surprise. And the countries that want to break international rules will know that this is coming and will prepare for this accordingly. The question is how effective would be the international payment systems. And what we see so far is settling the international transactions is still difficult without relying on Western banks and Western payment clearances. And this actually proved to be some of the effective secondary sanctions to enforce the trade sanctions that are in place.
So we've been speaking about Russian sanctions, so let's dig in there a little bit more. Clearly, the sanctions levied against Russia were one of the major motivations for this paper, which makes it, I think, particularly timely. one of the components of that sanctions campaign is a price cap on Russian oil, which I worked on extensively when I was Assistant Secretary at the Treasury Department. So as we, on this podcast, discuss Russian sanctions a bit more, do you guys mind first summarizing the sanctions regime levied against Russia and also discussing what you alluded to earlier, whether or not you think it's been effective?
So in terms of the sanctions on oil that you know so well about, I think it's a wonderful example because it encompasses different policy difficulties and benefits. So one is Russia is a dominant player in the oil market, right? We do have an issue of cost to sender. So just saying that Russia is not allowed to export 1 or 2 million barrels per day that is contributing to the market, well, contributing more, but to withdraw that much, it might have an impact on price, right? That might be costly to us in the sanctioning coalition. So what do we do? If we want to undermine Russia's ability to wage the war on Ukraine, we want to reduce their revenues. So eventually we have this oil sanctions, so oil embargo from the EU and then global G7 oil price cap, which says, look, we want to have Russian oil flow to the market, but at the same time, we want to reduce Russian revenues. These are two objectives. Sometimes they come in conflict, right? And that's when things get challenging. This is the reality of the policymaking. Nothing is straightforward and first best. So we ended up with the second best solution, oil price cap, together with the embargo. I think in the early days, and we have also a paper with Oleg and colleagues on it, is that we have seen the big wedge open from the price at which Russia was selling oil versus the price on the global markets. And that wedge opened because Russia had to find new markets. As you know, from Druzhba times, which is the pipeline that was completed in the 60s, Russian infrastructure is mostly in the European part, oil infrastructure, and then the shipment mostly, or that the pipeline used to go to Europe. So that worked wonderfully for many decades, right? But now it had to find the ships and the way to go all around Europe and make it its way to China and India. That's much more expensive, right? That's much longer travel times. So we created the wedge of the cost combination of the embargo, first and foremost, on the margin oil price cap. And that had an impact. However, over time, we hit two constraints. One is the so-called attestation process. In the oil price cap, for Russia to be able to get the services for the shipment, it needed to show documentation that it's selling oil under the oil price cap of 60. Well, if somebody were to ask me to pay my taxes with on a piece of paper that says Elena made no money this year and therefore shouldn't pay any taxes, well, that will be not always honorable. Maybe Elena will last, but at some time Elena will break and will start cheating. For Russia, the $10 difference on the oil price cap is more than $20 billion per year. This is a huge incentive to cheat. So our attestation process was not good enough always to force Russia to comply with the oil price cap. That is one. On the other hand, Russia moved towards so-called shadow fleet. The ships that do not get the service and are not registered in the G7 country coalition of sanctions. That means we basically have no leverage to impose this attestation process on Russia. And now the shadow fleet ships more than 70% of all the seaborne oil. And Russia maybe spent around $10 billion on that shadow fleet, which is again good because it's imposed the cost, but it's also difficult because it moves Russian oil away from the attestation process. So it's a fantastic story. We can have another podcast on it, but this is in brief our regime on Russian oil.
And to add a little bit more context to this discussion, it's important to keep in mind that Russia exports about 5 million barrels a day, and that quantity has not declined in the last 2.5 years. So it's been 5 million barrels a day very stably, despite all the sanctions and embargo. So the destinations shifted from Europe to China and India, but the quantities stayed the same. And at the same time, it's important to emphasize Russia exports at much higher world prices than before the invasion. The prices reached beyond $100, then they stabilized above $80. This is all very far from the $60 cap. So on one hand, you can say that, yes, a part of the price was shaved off by embargo, by various sorts of restrictions imposed on Russian energy sector, by the price cap. But at the same time, Russia was receiving a higher price than before the invasion. And a lot of this money went towards financing the war in Ukraine, or most of this money went towards financing the war in Ukraine. And in that sense, the policy was ineffective. It did not curb the revenues. So in a way, a price cap is a useful tool. It should not be discarded. It should be kept. But it's only effective when you can really bring down the world market prices, right? If the market prices are much above the cap, it's very hard to enforce it. If world prices come down, then the cap is also becoming increasingly more effective and easier to enforce. And so what we have not really seen much until perhaps very recently is the world oil prices coming down. And when the world oil prices are lower, it's much easier to enforce a lot of those policies.
So is it safe to say that your assessment of the price cap on Russian oil is that it was a creative design in theory, but that in practice enforcement wasn't sufficient to achieve its main objectives? Is that a fair characterization?
Yes, I think it is a fair description. And I think what is not fair sometimes is comparing that to financial sector sanctions. Because financial sector sanctions, US has the control of the critical node. In oil markets, US doesn't. Financial sector sanctions have been used for more than 20 years. This is a new creative measure, right? Financial sector sanctions are based on the industry, which is heavily regulated, prone to bank runs and wholesale bank runs, right? So it's obvious that we have much more power there. Oil price, not so much. But where the US actually has been very effective is trying to bring back financial sector sanctions, leverage them, including sort of a hint of secondary sanctions, to be able to enforce these new creative measures. So, for example, OFAC sanctioning tankers has helped to clean up a lot of the Russian shadow fleet. So I think this is an example where these measures can work together.
And it illustrates really well the common message that we're trying to send throughout the paper is that sanctions are a tool. Price cap is one example of a tool that you want to use. It is creative, but it's not a silver bullet or a magic wand. It doesn't solve all your problems. So you have to set the right expectations of what you can get from it. And the right expectation when the oil price is $100 a barrel is that the price cap will be difficult to enforce. And so if you start approaching it with the right expectations, then I think it makes a lot more sense. And it's clearly a tool that should be part of the toolkit for the Western policymakers.
Great. Let's stay on this topic of evaluating the impact of sanctions. So when I was at Treasury, one aspect of sanctions that we often discussed was the notion of frictions. So these are essentially the costs or other impediments to trade and economic activity imposed on sanctioned countries. So in the context of the price cap, for example, and Oleg, you noted this earlier, this included a widespread reshuffling of trade routes for exported Russian oil, which substantially elongated the time and cost of each shipment of oil. So instead of just 2 or 3 day trip to the Netherlands, we're talking about maybe 3, 4, 5 week trips to ports in India. And you allude to similar costs associated with financial sanctions in your paper. So you bring up, for example, bank runs within Russia in response to the financial sanctions levied in the wake of the invasion of Ukraine. So how do you both think about frictions in the context of optimal sanctions policy?
I think it is critical part of the sanctions policy to create this friction. You can think about sanctions, and you've seen it also in the literature, and we'll talk more about it in this paper, is that it's a market intervention in the end of the day. It's a government policy intervention to achieve a certain objective or sort of a greater public good, if I may, right? So therefore, it is based on the principle of creating friction in the market. And therefore, we should explain why we're creating this friction and what are the benefits and how we're planning to achieve this friction. So in the case of Russian oil example, indeed, right, if I'm going to sell water cheaper in my office versus the next door, right, I'll have a stampede of people until I create friction to prevent them from coming in, right? The same thing was the Russian oil price cap situation. So the fact, for example, that we forced Russia to spend money on the shadow fleet, and we're going to have another paper coming out soon about it, is that it's about 10 billion roughly that Russia was forced to spend on the shadow fleet. That's a very useful friction. It is something that they didn't spend on the weapons. At the same time, about the attestation process, we didn't create enough friction, and a lot of less scrupulous traders continued to work with Russia. The same thing about the financial sector sanctions. One could say that one of the frictions is that we need to be able to have compliance departments in the banks. They could say, well, why am I supposed to do that? But on the other hand, we're all interested in the national security of the country, and sometimes we are, by extension, being tax departments when we submit our tax forms, right? Or sanction departments of the Treasury when we screen for unscrupulous investors or payments going through the system.
So there is absolutely no doubt that adding more frictions to international trade for Russia or to financing is useful. Exactly as Alina pointed out, it shaves off a part of the revenues or increases the costs. And if you can shave off $10 or $20 billion, it's $10 or $20 billion less for the war financing. At the same time, to keep it in the perspective, Russia spends about $200 billion a year on the war and sells about that much of oil to the world market. And so in that sense, if you shave off 10 or 20% of the revenues, it's useful, but it's only 10 or 20%. And so in that sense, you need to have reasonable expectations. 10 or 20% less revenues will not put an end to the war or to a substantial chunk of the financing, but still it's very useful. And so the question is, how can you amplify it? How can you be more effective in imposing those costs and shaving off a bigger chunks of those revenues?
Great. Now, so Alina, you just brought up national security. So let's end with a big picture question in the spirit of the point you just made. So at a Brookings event this summer, Dileep Singh, who is the Deputy National Security Advisor for International Economics, gave a speech and he talked about the need to develop a doctrine of economic statecraft to help govern tools like sanctions as well as economic tools that would be mutually beneficial. So I think your paper would be a useful background for that effort, that is the development of a doctrine of economic statecraft. Moving forward, how do you see sanctions policy evolving in the coming years? And what do you hope policymakers will take away from your research?
We are absolutely flattered to be called the background for this doctrine of economic statecraft, because I couldn't agree more with Dileep. And if anything, we think that we also thought about it in exactly the same time. I think it is critical indeed to think about the doctrine and also think about the positive and negative reinforcement, right? We keep on thinking about sanctions, negative reinforcement, but also it can be positive. For example, better trade regimes for countries that do work with us. And for example, Yellen has spoken about it with so-called friendshoring, or it can be subsidized credits to countries to bring them into our coalitions, the so-called fence-sitting countries. So again, economic statecraft gives you all the tools. It gives you the government various tools. So we don't think that one tool can be a magic wand. None of them is, but in combination, they can be very impactful in terms of achieving certain measurable objectives. And I think that should also be part of the economic statecraft. Of course, if you don't have a target, you cannot miss it. But it would be nice for the effectiveness of the sanctions to actually have specific measurable targets and then measure our results against those targets to the extent we can and do the cost-benefit analysis. That should also be part of this economic statecraft doctrine. And I think what is critical is a good doctrine should minimize fragmentation. For example, I was not long ago at a conference in China talking about the global financial system. And what many Chinese academics say and policymakers that, look, it's all about geopolitical confrontation. The US wants to put China down because we have, as a GDP numbers, they love to show this chart, we have caught up with them and they're putting sanctions on us. And I'm saying, no, it can also be for other reasons, not just about you, right? And if we were to have this doctrine, we could explain that if a country refuses to abide by certain international rules, they shouldn't enjoy the benefits of this global international financial infrastructure. So therefore, if something were to happen to China and it would have to retaliate, not just military, but otherwise, they would also have an option of the financial sector sanctions or other sanctions within this global doctrine. Of course, this is, one could say, a wishful thinking example, but it does highlight the fact by having the doctrine, it's much easier to bring countries on our side for the sanctioned coalition countries when we have these rules and regulations of using this. Of course, it also raises a good question. Who is going to monitor that? WTO, global Bretton Woods institutions, NATO? That, of course, is even more complex discussion that we'll leave for the next podcast.
Yeah, and in the absence of such a grand bargain about what the doctrine is, what mutually agreeable rules of international engagements are, and what are the punishments for violating them, we're likely going to see more fragmentation, exactly like we already discussed, that countries would need to prepare for the possible use of sanctions against them, and they would try to substitute the Western financial system for the alternatives and making sanctions less impactful. So basically, the alternative to actually having a world coalition enforcing those rules is a world with a lot of fragmentation.
And so can I just summarize? I had 4 major takeaways as far as what you hope that policymakers learn from your paper. 1, provide positive reinforcement, not just negative reinforcement for actions. 2, provide measurable targets, perhaps not just obscure approaches to sanction. We want to identify the targets and then measure whether or not we're hitting them. 3, perform a cost-benefit analysis. So it's not just about the benefits of sanctions. We also have to consider the costs on the country that's imposing the sanctions. And 4th, and you both spoke about this to a fairly large extent, minimize fragmentation with the sanctions. Is that a fair summary of the 4 major takeaways?
Absolutely.
Thank you so much. This was a fascinating paper and a wonderful podcast. You did a terrific job of explaining economic statecraft. I think this will be an aspect of policymaking which will be with us for years, if not decades to come. And I'm sure that your paper will provide useful context as those developments play out. Oleg, Alina, thank you so much for joining us today.
Thank you, Ben.
Thank you.
Once again, I'm John Steinson.
And I'm Jan Eberly.
And this has been the Brookings podcast on economic activity. Thanks to our guests for this great conversation. And be sure to subscribe to get notifications about new releases of this podcast.
The Brookings podcast on economic activity is produced by the Brookings Podcast Network. Learn more about this and our other podcasts at brookings.edu/podcasts. Send feedback to podcasts@brookings.edu and find out more about the Brookings papers on economic activity online at brookings.edu/BPEA.
Thanks to the team that makes this podcast possible, including Kuilaleni Huanga, supervising producer, co-producers Fred Dews and Chris Miller, audio engineer Gaston Reboredo. Show art was designed by Katie Maris at Brookings, and promotional support comes from our colleagues in Brookings Communications.
I'm Jan Eberly, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research with real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading economists on the research they do and how it will affect economic policy.
Thank you for tuning in to this first episode of Season 5 of the BPEA podcast. This edition of the Brookings Papers includes another exciting set of economic policy studies, and we're thrilled to hear the conversations in this season of the podcast.
Yes, we'll be covering a lot of ground this season, including papers on the full employment rate of unemployment, economic impacts of the clean power transition, dynamic budget scoring, fiscal rules to stabilize the federal debt, and the economics of sanctions.
Plus, at the end of this season, we'll have a discussion on 3 papers that address the Federal Reserve's monetary policy framework. So we have a lot to look forward to. But now let's jump into our first discussion on U star equals square root UV, the full employment rate of unemployment in the United States, by Pascal Michiat of the University of California, Santa Cruz, and Emmanuel Saez of the University of California, Berkeley. Pascal is interviewed by Louise Shiner, the Robert S. Kerr Senior Fellow in Economic Studies and Policy Director for the Hutchins Center on Fiscal and Monetary Policy. John, it's not often we have a paper with a formula in the title.
No, but I really love this title. It's such a simple formula, almost like E equals MC squared.
Oh, come on. Maybe not.
Well, maybe that comparison is a little over the top.
Maybe so.
But even so, it's an exciting paper because it proposes a new way to think about full employment. Most earlier work has equated full employment with the NAIRU, that is the rate of unemployment consistent with stable inflation. But that is a very inflation-focused view. Pascal and Emmanuel take a much more employment-focused view that takes the maximum employment mandate of the Fed more seriously. And they argue for a relatively simple metric based on this outlook, which is very interesting.
And particularly because it gives a very different view of how tight labor markets have historically been. They think there was more room to grow employment. So with that, let's hand it over to Louise.
Thanks, Jan and John. I'm really excited to be here today to discuss with Pascal his new paper, U star equals the square root of U times V, or the full employment rate of unemployment in the United States. Really nice to see you, Pascal, and to have this chance to chat with you.
Hello, nice to see you, and thanks for having me.
Okay, so your paper gets right to the heart of a really important question in modern monetary policy. But even as I try to make my way through the title, you can see the title might look like a cryptogram to non-economists. So let's start with decoding it. We'll start with the left side of the equation. What is U star, and why is it important to the Federal Reserve?
Yes, so U star, it's the full employment rate of unemployment. So the acronym for that is FERU. So it's the unemployment rate that prevails when the economy is at full employment. So now, why do we care about that unemployment rate, and why does the Fed especially care about it? It's because the Fed has two mandates. One is to keep prices stable, but the other mandate is to keep the economy at full employment. And to be able to keep the economy at full employment, the Fed needs to know, well, what is full employment, whether they are at it or whether they are far from it. And so that's why this U star is going to be important for them, because it will allow them to respond to shocks and turbulences that hit the economy and try to get as close as possible to full employment.
So I think for non-economists, they might say, well, why isn't the best unemployment rate 0?
Yes, that's a very good question indeed. So the simple answer is that it's just not possible to have 0 unemployment. The reason is that on the labor market, there is this thing called a Beveridge curve. And that Beveridge curve is something we've discovered a long time ago. In fact, it was discovered in the UK, and then it turned out that it also existed in the US. So that Beveridge curve is a relationship between unemployment and vacancies. And it's telling us that as you reduce the amount of unemployment in your economy, you're going to increase the number of vacancies in your economy. These two things move together. So essentially what this is saying is that if you want to reduce unemployment, you need more and more recruiting to occur in your economy so that you can absorb people who always flow into the pool of unemployment. But it turns out that even if everybody in the economy was only doing recruiting, we only recruit other people all the time, even in these conditions, actually, the Beveridge curve tells us that you wouldn't be able to constantly have everybody employed. So if you want a technological limitation, the fact that you constantly have people who flow into the pool of unemployed means that you won't be able to have 0 unemployment. So it's very much like if you have a bathtub and you constantly have water dripping into the bathtub, even if you have a big hole into your bathtub, you'll always have a little bit of water sitting at the bottom. So that's the logic. And in fact, if you go back to the 40s, when people started thinking about full employment, so especially in the UK, Beveridge, also Joanne Robinson, after the war, they had realized already at that time, so in the mid-40s, they had realized that full employment couldn't mean 0 unemployment, because you constantly have these flows of people who come into unemployment either because they lose their jobs, they quit their jobs, they are moving to a new city and they have to find a new job, or, they're graduating from school and they're moving into the labor force. These constant flows just make it impossible to eliminate unemployment. And that's why you need that target that's not going to be 0.
Great. So you already talked about the Beveridge curve. It's the relationship between the two other variables that are on the right side of your equation in your title, U, the unemployment rate, and V, vacancies. Now, your title says, here's what the best unemployment rate is. It's the square root of the product of the unemployment rate and the vacancy rate. How did you come up with that? What's the intuition for why that's the optimal unemployment rate that the Fed should be targeting?
Okay, so let me first tell you a little bit like what that square root UV means. So it's true, it looks a bit cryptic, but really, if you remember math classes, you know that square root of UV, what this says that it's just a geometric average of U and V. So really what this is saying is that it's going to be the midpoint of U and V. And there are many ways to find midpoint. So here it's not going to be the typical U plus V divided by 2. It's not going to be an arithmetic average, but it's going to be a geometric average. But essentially, it's a midpoint between U and V. So now, why is it that we want to be in between U and V? It's because at some level, unemployment has a cost, right? So when people are unemployed, they're staying at home, they're not producing anything. Vacancies, and I've hinted at that already, also has a cost, because if firms are trying to fill their vacancies, they need to devote labor to recruiting new workers. And it turns out that these costs are actually comparable. So that's something we find in the data. And the Beveridge curve, as it also turns out, is very symmetric. So the unemployment rate and the vacancy rate, they play the same role in the Beveridge curve. So technically, the Beveridge curve turns out to be a rectangular hyperbola in the US. But it's just saying unemployment, vacancy plays the same role. And so you can see at the end of the day, unemployment and vacancies, they just show up in exactly the same way. They have the same cost. They enter in the same way in the Beveridge curve. And so because of that symmetry, the best place you can be is just in the middle of the unemployment and vacancy rate. So that's what this formula says. So now, how did we come up with that? Actually, we didn't come up with that immediately. We've been working on these topics with Emmanuel for a while now, for 15 years, basically since I graduated from grad school. And what we realized is that what's very important for a lot of policy is this efficient rate of unemployment, what you mentioned, the desirable rate of unemployment. But we had no idea what that was. And so we started working on that. And we have a previous paper in which we develop a much more complex formula for that efficient unemployment rate. But then what we realized is actually in the US, given the value of all the statistics in the formula, you could actually simplify it greatly and get that maybe cryptic, but for macroeconomics, quite simple formula that gives you that U star. But it's kind of the second step in the research project. Initially, we had something much more complicated that then we were able to simplify.
But the intuition is that both unemployment and recruiting is by itself costly for society because it's not directly producing anything. You might need to go through it in order to get a job, but it in itself isn't producing anything. Similarly with a recruiter at a firm who's spending their time to find someone. And so they're equally costly, and so you want to have them set the same. But how do I think about changes in technology over time about recruiting? I mean, recruiting before we had email, before we had those big job listings, now we have AI. How do you see that this is a concept that would be kind of constant over time?
Yeah, that's a great question. So actually, one issue is that we don't have as much evidence on recruiting cost as on other things. And what we hope is that if our research becomes used more widely, hopefully, we'll collect better data on recruiting. So I have to say, we don't have that much evidence on it. And so especially knowing how these recruiting costs change over time, what I'm going to tell you, we are not 100% sure. But what I can tell you is that we have two good pieces of evidence. And one comes from the late 90s and one comes from 2011, 2012. So about 15, 20 years apart. But it turns out actually that from these two surveys, the recruiting cost doesn't seem to have changed in the US. Also, between the late 90s and 2010, internet appeared. The recruiting technology changed quite a lot, but we don't find evidence that these recruiting costs have shrunk a lot. And now if we think a bit about our own experience, recruiting in the academic world, what has changed? Like when I was on the job market, I had to mail this 100 of applications to places all over the world. You had to fly to be interviewed by new universities. So that all has disappeared. Now you apply online, you do your interviews on Zoom. But for the recruiting departments, a lot of the costs are still there. What's very costly? You have to read 200 or 500 applications from job market candidates. That still takes the same time. You have to spend 3 days interviewing everybody. That takes the same time. You have to spend a month flying out people, attending job talk, attending job market dinner. That takes the same time. And then you have to debate with your colleagues about who you're going to hire. That takes the same time. And so it's true there are marginal improvements, but the big chunk of labor that you spend doing the recruiting, that's still there. And I think inevitably, it's going to be there just because it takes time to find the right colleague for your department. And in firms, it just takes time to find the right colleague to work with you and to fit the needs of the firm.
Great. That's interesting. And that makes sense. So based on your measure, you use historical data over a very long time period. You find that typically the U.S. labor market has been too slack. In other words, the unemployment rate is too high over much of the past 90 years or so. Why do you think that is?
Yeah, that's a great question. So we devote a section in the paper trying to think about that. And we can look a little bit over time to try to understand why there was so much slack. So obviously, the first time that the government in the US had a full employment mandate was actually only after World War II. So that was the Employment Act of 1946. Before that, there was no employment mandate. There was no mandate of full employment or concept of full employment. So it's not something that the government had to do. But nevertheless, it's well understood that during the Great Depression, the Fed, and if you go back to Friedman and Schwartz and also Ben Bernanke's new book, it really shows that the Fed made some mistake during that time in the 30s. So this clearly could explain why maybe the unemployment rate was so high compared to where it should have been. Now, after World War II, this full employment mandate was introduced. If you look at the 50s and 60s, unemployment was sometimes too high, but it was also sometimes too low during the Korean War, during the Vietnam War. So we were kind of moving around the full employment level. And in fact, if you go back to discussions of policy at that time, policymakers, they were often taking 3% or 4% as their full employment target. And it turns out that that's also what we find. So it turned out they had a good idea of what full employment was, and the policies were such that the labor market was kind of hovering around these levels. Where things started to go off a little bit is after the 70s. And in fact, it's quite extraordinary. From 1970 to 2018, the labor market in the US was always inefficiently slack. We touched full employment, in 2000, just before the end of the dot-com bubble, but we were always too slack. And so it's quite interesting why that happened. And so we looked a bit at people who study the Federal Reserve, and there a lot of people have found that since the 70s, the Federal Reserve seems to have exhibited anti-inflation bias. So they've paid much more attention to inflation than to unemployment. And people have done that systematically. They looked at communication from the FOMC, and what you find is that inflation is mentioned very, very often. Unemployment or full employment were absolutely never mentioned during that time. So there seemed to have been, on the policy front, a little bit of a bias and a lot of focus, maybe because of the 70s, a lot of focus on inflation, very little focus on unemployment. So that's the policy. But it turns out that in academia, there was the same bias as well. So if you want to study monetary policy these days, you have to learn what's called the New Keynesian model. Now, there are two main textbooks to study the New Keynesian model, one by Jordi Galli that was published in 2008 and one by Mike Woodford that was published in 2003. You look at the index of these books, unemployment doesn't show up. Well, okay, it shows up once at the end of the Galli book, but you have 1,000-page of textbook on monetary policy. The word unemployment is not in this textbook. Now you go back to the general theory of Keynes, you look at the index, and there you have about as many times unemployment as inflation. So the New Keynesian, in that way, they were not very Keynesian because they lost that balance between unemployment and inflation, and they really focused only on inflation. And so these two things, there was no academic work on unemployment in the monetary field, and maybe there was a bias on the policy side that paid more attention to inflation than unemployment, and as a result, what you get is a lot of slack on the labor market for about 50 years.
That's really interesting. And I hear what you're saying about the 70s, because I know people who have lived through the high inflation of the 70s were kind of scarred by it, right? And it's like, oh, we can't do that again. So let's talk about what happened during the pandemic. So you said until 2018, it was just maybe right before the pandemic that the labor market got tighter than U-Star. What happened during the pandemic to the labor market, according to your measure?
Yeah, so pandemic was very interesting. So first, of course, at the beginning, there was a huge spike of unemployment. The labor market was too slack, but the labor market recovered quite quickly. And by the middle of 2021, we were back at full employment. But then the labor market didn't stop. So then it kept on heating up, and it became quite, according to our measure, it became quite hot. So by the middle of 2022, this measure of labor market tightness reached a value of 2. So basically, we became as hot as we were in 1945 coming out of World War II. So we had never been so hot in the entire post-war period. So it's quite exceptional how hot it became. And then after that, of course, the Fed started tightening monetary policy and the labor market started cooling. And we've been cooling since the middle of 2022. And I imagine that in the fall, so this year, 2024, we will probably be back exactly at full employment. We are very close to full employment right now as we speak in September 2024. And so the question is, why did that happen? And I think there are two sides. One is aggregate demand. There was a huge fiscal stimulus after the pandemic. Monetary policy remained also quite accommodative for about 2 years. So that, of course, tends to make the market tight. there was also a very low aggregate supply, very low labor supply, because many people dropped out of the labor force during the pandemic because they didn't want to get sick. They had to look after maybe family members who were sick, schools were closed, they had to look after their children. So you have a low labor supply, very high labor demand, and of course that's a recipe to have a very tight market.
So, as you said, we're sitting here in September. We don't know what the Fed's going to do at the next meeting, but let's look a little beyond this episode. Do you have any sense of whether or not we should be thinking that, well, nothing much has changed, so since the unemployment rate was typically too high for most of the past 20 years or 30 years, that's what we expect it to happen again? Or do you think it's going to end up going back to what you think the equilibrium should be?
Yes, I mean, that's a tough question. Forecasting is not easy. The only thing I can tell you is that, so, in this paper, we use these unemployment and vacancies to try to figure out what the Fed should do, what the Fed should target. We have some other work that's trying to use the same data on unemployment and vacancy to identify recession early on. And actually, what we find using that is that it's quite likely that the US is in recession right now. We put the odds around 50% using our method, and the US might have entered a recession as early as March 2024. So if that other work is correct and we've entered a recession, then what you would expect is that, of course, once you are in a recession, usually the labor market cools quite a lot. And so if that happens, we'll probably keep cooling for a little while. And as a result, we'll end up being inefficiently slack again and below full employment. It's a bit hard to say, of course, who knows what will happen, but at least using this unemployment and vacancy data to make a bit of forecasting suggests that, yes, the labor market has been cooling quite a lot, and it's quite likely that it will continue cooling in the fall.
And so if that measure is correct, then the Fed was just behind the curve again in terms of when they started to cut rates. Is that the implication?
Possibly, but obviously what we propose is just one measure. We finished writing this paper, a month ago. It's very hard for the Fed to know. Some other indicators of recession that are out there, they're a bit slower than this measure we developed. So they haven't really picked up on that. And we are not yet at full employment. So the, inflation is still a little bit above 2%. The labor market is still a little bit too hot. I think the Fed is doing, if they cut in that September meeting, that for us is in the future, I think, that would be a pretty good job. Of course, the issue is that then monetary policy take a bit of time to bite completely, to become active. And so they may end up being behind the curve because of that, because of the delay that monetary policy has in taking full effect on the economy.
So the point of your paper is that the Fed should be focusing on your measure of U-star as their target for what full employment looks like. And you might say that one of the things that the Fed has done is maybe focus on a measure that they think unemployment rate should be higher than what you think. Maybe that's one interpretation for why they have actually been higher. So you talked about the beginning about how the Fed has the dual mandate, the inflation side and the employment side. So what would happen to the inflation side of their mandate if they're like, oh, your measure is better, we're going to start focusing on that as our measure of unemployment? What happens to that trade-off?
The trade-off is always there. There is a trade-off. It might not be possible to both achieve full employment and inflation target. The Fed may have to decide how much to deviate from both and decide how much weight you're going to put on one versus the other. So that's always there. But we're just saying, yes, what you should target for full employment is lower than what you thought. And in fact, one of the measures that the Fed often uses is what's called the natural rate of unemployment that's produced by the Congressional Budget Office. If you look historically at the value of that natural rate, it's been between 1 and 2 percentage points higher than what we propose. And so this could, in fact, explain what we see in the data. If the Fed thought that this natural rate produced by the CBO is the true measure of full employment, then they've been, on average, kind of right. Our issue, of course, is that there is no real foundation for that natural rate. And in fact, if you look at the appendix about how it's constructed, what it does is that it assumes that at some point in time we're at full employment, and then it projects forward where the labor market should be to replicate this condition. So currently it assumes that in 2005 we're at full employment, and then it projects forward where we should be to replicate the 2005 condition. But of course, we don't know if at 2005 we were at full employment or not if we don't have a theory of full employment. So it really starts from a totally arbitrary assumption, and then it computes the labor market that's consistent with that. So we're trying to improve on that and have a theory of what it means to be at full employment.
And of course, your methods are applicable not just to the United States, but to central banks across the world. And you talk about how the new measure has the potential to be quite important just in general. What do you see as the barriers for people to adopt this measure for in general?
Yeah, well, that's very interesting. I think there are a little bit two ways to think about it. So one is that an issue we've been facing, and that's not just this paper, but all the work I've done with Emmanuel over the past 15 years, we've developed a whole theory of business cycles and how to deal with business cycle. We thought about fiscal policy, monetary policy, unemployment insurance, but we haven't had, much impact. And we are very grateful. I'm so happy that Brookings decided to invite the paper, and I get to talk to you here and try to publicize a bit this work. But so why that was? So I think there are two things. So one is that in terms of, if you just look at the type of work we do, we borrow a lot of tools from what's called macro labor. So it's a field of macroeconomics that study unemployment. And we try to apply these tools, in this case, to say monetary economics. So the field of macros that looks at what the Fed does. And the problem is that people in monetary, we talked about it, they're really not used to these models, this data, they don't know about vacancies, they don't think about these models of unemployment. So for them, these tools are completely new, and it's always hard to learn new tools. And then the macro labor people whose tool we use, they are not interested in monetary policy, or in fact, very much in stabilization policy. So they don't think the questions we're looking at are interesting. So we're a little bit in a vacuum here, using tools to study questions, but they're from different fields. So who knows whether this will take off or not. And, macro people are always a little bit conservative. We all are, I think. People are used to their methods, they're used to their tools, and it's kind of hard to convince people to switch to new tools. And in fact, I've done some work on that with George Akerlof, trying to think about how new ideas emerge in science. And it's always very hard. So it's hard to tell whether this will become something or not.
All right. Well, it was a really interesting paper to read, and I am sure that people at the Fed will pay close attention to it. And so really thank you for writing the paper and for being on with me today.
Thank you, Louise. It was nice to talk to you.
Once again, I'm John Steinson.
And I'm Jan Eberle.
And this has been the Brookings podcast on economic activity. Thanks to our guests for this great conversation, and be sure to subscribe to get notifications about new releases of this podcast.
The Brookings podcast on economic activity is produced by the Brookings Podcast Network. Learn more about this and our other podcasts at brookings.edu/podcasts. Send feedback to podcasts@brookings.edu and find out more about the Brookings papers on economic activity online at brookings.edu/BPEA.
Thanks to the team that makes this podcast possible, including Kuilaleni Huanga, supervising producer, co-producers Fred Dews and Chris Miller, audio engineer Gaston Reboredo. Show art was designed by Katie Maris at Brookings, and promotional support comes from our colleagues in Brookings Communications.
I am Jan Eberle, the James R. and Helen D. Russell Professor of Finance at Northwestern University.
And I'm John Steinson, Chancellor's Professor of Economics at the University of California, Berkeley.
We're the co-editors of the Brookings Papers on Economic Activity, a semi-annual academic conference and journal that pairs rigorous research and real-time policy analysis to address the most urgent economic challenges of the day.
And this is the Brookings podcast on economic activity, where we share conversations with leading economists on the research they do and how it will affect economic policy.
It's been over 4 years since COVID-19 first appeared and had a wide impact on behavior in the United States and the world. A new study, which will be discussed on today's episode, presents a new model looking at the efficacy of the U.S. response and lessons to be learned for future public health crises. Andrew Atkeson of the University of California, Los Angeles, and Stephen Kistler of the University of Colorado, Boulder, are the authors of the new paper, The Impact of Vaccines and Behavior on U.S. Cumulative